Okay, notice the time and place of these committee meetings was publicized by notifying the area news media, by updating the OPPD website, and by emailing such notice to each of the district's directors on March 12, 2021. Thank you all for joining us remotely via WebEx events. As a reminder to board members, senior management, and OPPD staff, please mute your microphones to reduce background noise. To members of the public, thank you for attending. You are in listen-only mode. If you have technology questions, please use the chat feature in WebEx to communicate with the event host. Our agenda for today's meeting is as follows. We will conduct a closed session to discuss 3 items. 1, powering the future to 2050. 2, power with purpose. And 3, a quarterly update on enterprise risk management. We will conclude the discussion no later than 9:45 a.m. in order to open the WebEx meeting to allow the public and OPPD staff to join. We will begin public session at approximately 10 a.m. and receive reports from each committee. Director Moody, do we have a motion to go into closed session?
We do, in fact. I move that the board go into closed session at this time, 8:01 a.m., to discuss 3 topics. Powering the Future to 2050, which is OPPD's 30-year strategic future business planning effort. 2, a Power with Purpose generation resource update. And 3, a quarterly update on enterprise risk management. With respect to Powering the Future to 2050, the discussion of OPPD's strategic future business planning issues over the next 30 years, a closed session is necessary for the protection of the public interest because the discussion will involve competitively sensitive information related to district assets and potential business strategy that would create a competitive disadvantage to the district if known by its business competitors or used in the energy marketplace. The discussion also is preliminary, and any strategic plans or initiatives that are proposed by the board or management for adoption or approval will be presented and discussed in future public meetings. With respect to the update on the Power with Purpose generation resource project, a closed session is necessary for the protection of the public interest because the discussion will involve competitively sensitive utility infrastructure information, including potential pricing and types and locations of resources that would create a competitive disadvantage for the district if known by its business competitors, and also would create a competitive disadvantage for the district if known by potential contractors and property owners that may be involved in the infrastructure projects. The update also may involve discussion of legal matters, including contract negotiation matters that are protected by the attorney-client privilege. And finally, with respect to the quarterly enterprise risk management update, a closed session is necessary for the protection of the public interest because the discussion involves matters that are confidential and protected by the attorney-client privilege and attorney work product doctrine, including an update on potential litigation matters, and involve the discussion of security for district property and utility infrastructure information. This motion requires a second to move forward. Do I have a second?
Second.
All right, Ms. Henners, will you please call the roll?
Bogner,
Yes.
Kavanaugh,
Yes.
Howard,
Yes.
Mulhoff,
Yes.
Moody,
Yes.
Spurgeon,
Yes.
Williams,
Yes.
Yoder.
Yes.
Motion carried.
All right, the motion to go into closed session has passed. This closed session will be limited to discussion regarding Powering the Future to 2050, OPPD's 30-year strategic future business planning effort, a Power with Purpose update, and the quarterly enterprise risk management update. No votes or other action will be taken. At this time, public attendees will be removed from the WebEx event, and we will stop the WebEx event recording. All right, I have 10 o'clock. Let's get this show on the road. A motion and second is required to reconvene an open session.
So moved.
Second.
Thank you. Ms. Henners, will you please call the vote?
Bogner,
Yes.
Kavanaugh,
Yes.
Howard,
Yes.
Mulhoff,
Yes.
Moody,
Yes.
Spurgeon,
Yes.
Williams,
Yes.
Yoder.
Yes.
Motion carried.
All right, the motion to come out of closed session at 10 a.m. is carried. This closed session was limited to discussion regarding powering the future to 2050, OPPD's 30-year strategic future business planning effort, a Power with Purpose update, and a quarterly enterprise risk management update. No votes or other board action were taken during the closed session. Earlier, before the closed session, I made the announcement regarding public notice of this meeting. As a reminder to board members, senior management, and OPPD staff, please mute your microphones to reduce background noise. To members of the public, thank you for attending. You are in listen-only mode. If you have any technology questions, please use the chat feature in WebEx to communicate with the event host. Per the board's guidelines for public participation, we do not take public comment during the all-committee meeting. We will take public comments at the board meeting on Thursday, March 18th. Joining me today via WebEx are my fellow board members, Mike Kavanaugh, Sarah Howard, Janice Mulhoff, Craig Moody, Mary Spurgeon, Eric Williams, and Rick Yoder. We also have President and CEO Tim Burke, our General Counsel, Steve Bruckner with the Fraser Stryker Law Firm, members of our senior management team, and OPPD staff. Additionally, we have about how many, Brent, public attendees?
Currently have about 19 online, but it is also a mixture of OPD employees as well as public attendees.
Thank you very much. We conducted a closed session earlier to discuss 3 topics: Powering the Future to 2050, which is OPPD's 30-year strategic planning effort, Power with Purpose Solar and Natural Gas Generation Resource Project, and a quarterly enterprise risk management update. Today, we will hear the following committee reports: Governance from Director Craig Moody, Finance from Director Rick Yoder, Systems Management and Nuclear Oversight by Director Eric Williams, and Public Information from Director Janice Mulhoff. Tim Burke will now give us the safety briefing.
Great. Good morning, everybody. And we're going to continue with our COVID-19, the 10 actions every Nebraskan can take. Even though we're seeing an increase in vaccines occurring, I think it's still clear, even with a vaccine, you can obtain COVID-19 and you can give COVID-19. The vaccine just limits some of the very hazard, life-threatening implications of that. At least that's the intent. And so we practice at OPPD what we call our 3 W's. Wash your hands, wear a mask, watch your distance. And we're going to continue to do that. And as I said in an interview with David Earl the other day, I think these are some practices we're going to be bringing into our Reimagine OPPD kind of in the future as we get into flu season, cold season, whatever that may look like, and the opportunity to be able to use these techniques that we've learned to keep our employees and our families safe and healthy. So thank you very much.
All right, let me unmute. Okay, now we will begin. We're going to shake things up a little bit and have governance go first. So, Craig?
This is what happens when you give me control of governance. I change the whole schedule. We'll go, in all seriousness today, we wanted to move governance first so that we could give the public a very clear signal as to when they might be able to listen in to learn about our CEO selection process. So we'll go back to a regularly scheduled program next month. But before we get into that, just a quick update on the governance committee. We met on March 11th. And there are a couple things that I wanted to highlight for the non-members of the governance committee and for the public in particular, specifically as it relates to Powering the Future 2050. In that meeting, the committee briefly learned of high-level progress on the senior management team's recent Powering to the Future 2050 efforts, and we discussed and determined a 5-month process leading towards a release of a strong draft for stakeholder review and comment in July 2021. Board members, we talked about this in our closed session this morning. So for those of you in the public listening in, I want to want to just back up a little bit and provide an update. So in response to the board's strategic directives, and in particular the net zero by 2050 goal that the board set in 2019, CEO Burke and the senior management team felt it necessary to put together a vision framework for 2050 to achieve the goals of these policies. The work started in March 2021 and has been underway since, and actually that's March 2020. Rebecca Ryan and Lauren Azar with Next Generation Consulting were brought on board to facilitate the process, which consisted of a multi-step process to examine biases and really explore different scenarios for where 2050 might look to go. While the board's strategic directives provide guidance in the form of policy, the board was also involved in the visioning process via bias training and one-on-one interviews with Ms. Ryan and Ms. Azar during the summer of 2021. So we have been engaged throughout the process. Nevertheless, senior management has since been hard at work, exploring potential scenarios, working through first principles, and working towards a draft for powering the future to 2050. That naturally aligns with these 5 strategic initiatives that we have in place already, and again, builds on and is responsive to the strategic directives that the board has in place today. So again, this morning in closed session, the board did receive an update on recent progress and next steps, and we're looking forward to future discussion. I'll pause for a minute. Other governance committee members, anything more to add on this particular topic before we move on? Seeing shakes. Okay, let's keep going. So I also wanted to provide a quick update on the enterprise risk management specific to the polar vortex after action review. Our last board meeting was immediately on the heels of the polar vortex. So at our governance meeting, we did get a quick update on what the plan is for that after action review. And broadly speaking, it consists, the scope is kind of 4 parts: planning and preparation. So when was the event identified and what steps were taken to prepare? The second part of the scope is the response and execution. So as the energy emergency event occurred, what was OPPD's response? Third, peer benchmarking. So what best practices from other organizations can we learn? And finally, as part of that scope, the future consideration. So what options does OPPD have to improve resiliency for the future? So from a timing standpoint, the initial report is anticipated in May, and that's going to cover the first 2 parts of the scope. And then the final report will be in July, so that will include all 4 parts of the scope. And the board will be involved. In particular, the plan now is to send the board a forum to gather input related to the scope above. And all of those responses will be aggregated and provided to the review team to be appropriately integrated into the project. So point here is the process is moving, work is underway. The board will be involved and have an opportunity to provide input. And we should see something in a couple months in terms of that initial report. This is just OPPD's work, right? Many of the parties involved, the SPP and others, are doing similar work, but this is really for the public. This is our portion of the work to really re-examine how we performed and what opportunities we have to improve. Pausing again, governance committee members or anyone else, comments or questions? Okay, let's keep going. And then the last item on the committee chair report is the executive development. So that is, we can go on to the CEO selection process. So what I want to do here is I'll just kind of offer some context and what the next steps are, and then any questions, comments that the rest of the board wants to weigh in on, by all means, I want to make sure that we have as much clarity around this process and are being as transparent as we can around what to anticipate as we go. But I want to start first with what's happened to date, what's gotten us to today, and then I'm going to pivot to what to expect going forward. So a quick walk down memory lane. On March 11th, Tim announced he's retiring on July 2nd of this year. He informed the board in early to mid-February of this announcement, so we've had a little bit of time to to digest and think about what the path forward needs to be and should be for our selection process. The board during February's closed session discussed the CEO selection process and the status of executive development for that role in particular. And eventually we aligned on a process that's going to focus on internal candidates, and our desire is to hire an internal candidate. But let's be clear about what our objective is. It's to hire the best person to lead this organization. And that's really what we, without any disagreement whatsoever, the board's consensus was that that's the highest priority here. A priority for Tim and his role, and as reinforced by the board over the course of the last several years, was to build a team of people with great talent and passion for the work. And many of us agree that that has definitely been the case, and we're really excited about the team that is in place. So it's our hope that we'll be able to fill the CEO position from that talent pool. This does not preclude us from expanding the search to an external talent search should that need arise. One of the most important things that I think is important for the board to acknowledge and recognize, and I want to be sure the public understands as well, is we are in step one of this process. We've got a good process that we'll walk you through here in a minute, but there is a lot that will happen in the next 2 months that could spin us in a particular direction one way or another. We don't know which members of our internal team today are going to be interested in the job. So we want to let the process play out, and we will adjust course as we go. The process may speed up, it may slow down, but we've got a good framework in place, and we've got good places for the public to plug into that process. So, what to expect going forward. We're already collecting input from the public, employees, and other stakeholders at OPPDcommunityconnect.com. That will stay open through April 6th. So if you have any interest in sharing your views with the board on what we should consider and think about as we're going through this selection process, we strongly encourage you to use that tool to provide us that input. We'll use that to inform our selection criteria and interview questions. So please, if you're a member of the public, if you're an employer, if you're a stakeholder, use that to provide that input. We really, really want the public's input on that. In early April, candidates will declare their intent. In mid to late April, we'll conduct some interviews, and the board already has holds on our schedules for those interviews. So we're getting out in front of it, making sure that we've got that time carved out. And we'll provide an update at our April board meeting. Again, the process will ebb and flow a little bit, so I can't tell you exactly what that update will consist of, other than we will have conducted some interviews ideally by then, and we'll be able to talk a little bit about where we're at and what's coming forward. But don't expect the April board meeting to be a big dog and pony show with a lot of information, because we are going to be in the thick of it at that point. Over the months of May and June, once we get to finalists, we'll post those finalists information on OPPDcommunityconnect.com, and finalists means 4 or fewer. So once we hit that threshold, that information will be posted. And that doesn't mean 4, that means 4 or fewer. So it could be 1, 2, 3, or 4. We're planning some virtual meet and greets with the finalists. We will eventually name and seek input on the finalists. And then eventually the board is obviously going to vote on who our next CEO will be. So as I've mentioned, it's really important to note that this process is going to be pretty dynamic. We've got a framework in place, we've got steps, we've got a very thorough timeline that lays out what will happen and when, but it's going to evolve. All good plans do, and so the board is ready and willing to adjust course as needed, because we'll gain much more information as we get going. But whatever the case, we're committed to communicating to the public in as many mechanisms as we can. That's a big priority for the board, and so we will be sure to let the public know what's going on. So before I stop talking here in a minute, I want to summarize for the public the anticipated opportunities for public input, because again, this is an important part of our process here. One, OPPDcommunityconnect.com is now open, and we're taking input through April 6th. In 2 days, March 18th, we have a board meeting, and we don't have anything on the agenda, but there's an open comment period, which people can always provide us comments. The next opportunity that is known today is the April board meeting. Again, we'll see whether or not we need to have something specific on an agenda there, but at the very least, we'll have an open public comment period. Finalists will be listed on OPPD Community Connect, so that's another opportunity for public input. We'll then have the May and June board meetings, and again, like what the timing there is once we get to May and June is a little bit in flux, but our anticipation is we'll be in a pretty good spot by then. And then I'll just reinforce the always available and open to anyone, the board contact form that's available on OPPD.com. By all means, if that's the way in which you prefer to connect with us as board members, by all means use that, and we'll make sure that input gets put into the right place. Okay, I'm going to stop for a minute and see what either governance committee members, please feel free to chime in. I'm also happy to take refinements and clarity from Mark Sedke, who is our Director of Human Capital, who has been really leading the charge on this process and helping us define it, and Lisa Olson, who has been helping to ensure that we've got kind of the plan for public input refined. So I'm going to shut up for a minute and let you all see what comments or questions you have.
I don't see any hands raised right now, but I'll just underscore the emphasis is to find the right candidate for the role. And I think we have a good process in place to help us along in that effort. It has been said by a few board members that this might possibly be the most important job as board members we have, and I absolutely agree with that. So if we're able to fill the role with the right person, then all things fall from there. So fall into place from there. So let me be more clear. All right, it looks like Director Kavanaugh might have a question. Mike, we can't hear you if you want to ask.
I'm sorry, here we go. Yeah, I spoke with Amanda and Craig individually, and apparently it's still up in the air somewhat whether the interviews will be conducted live in person. I think it's critically important that these candidate interviews be conducted live and in person. Again, it'll be particularly difficult for our newest board members who may be interviewing candidates they've never even met before. And I just want to emphasize that whatever we need to do, whatever precautions we need to take and so forth, the meetings need to be in person, I think. Thank you.
Thank you, Mike, for voicing that. I concur, and so we'll figure out what that process needs to look like, what precautions need to be taken, and we'll see if we can get that worked out. All right, let's see. I don't see any other hands raised. So, Craig, are you complete?
Yes, I am.
Yeah, I am, so long as, yeah, unless there's Mart or Lisa, if I missed anything in that summary, just want to make sure that, again, being as clear and open as possible to provide that input. So yeah, I'm complete unless anybody has any comments or questions or filling in gaps.
I think you covered it quite well, Craig. Thank you.
I concur. Thank you.
I have one more question, if I could, Amanda.
Sure, go ahead.
I address it to our legal staff, and that is the question of whether the entire board in executive session can interview the candidates rather than going 4 at a time. I can understand the political ramifications of not doing it in executive session. I'm just trying to find out for sure where exactly we stand legally if we would choose to have the entire board interview the candidates at one time, or for the entire board to interview a candidate rather than doing 4 at a time.
Steve, are you able to address that?
Well, yes, I am. We did discuss this in the governance committee. I'm hesitant to provide legal advice in an open meeting for fear of losing any privilege that's attached to it. I will say, however, that the short answer to Director Kavanaugh's question is that the board can interview in the manner that he mentioned. The decision as to how that's going to be done, I don't believe has been made in a final way yet. But I can provide further information on that particular legal matter in a closed session if needed.
Okay, Steve, if you don't mind, maybe I'll give you a call later on today or tomorrow and discuss it. Okay.
That'd be great.
Thank you. That's all I have.
All right. Any other questions? I am seeing none. I'm seeing no raised hands. So we will move on to the Finance Committee. Director Yoder.
Thank you. And I'm looking forward to some great conversations here in the very near future. The Finance Committee met twice since the last, well, members of the Finance Committee met twice since the last board meeting. On February 23rd, we had the Retirement Fund Semi-Annual Manager Review. That's done twice a year, and 3 of the members of the committee were participated in that. And other board members are welcome to attend the next one, but certainly all the information that you need to review that is in Diligent, and we'll see some of that, I think, here today. The 2 things that we discussed on March 5th are going to be on the agenda here today, so I'm not going to ask you to sit through my take on it when you're going to get a much better one by CFO Fernandez. So with that, let's go ahead and move to the agenda. And if I can, Mr. Fernandez, can I ask you to pick up the agenda?
Certainly. Can you hear me?
Yes.
Great. Thank you, Director Yoder. We have a busy agenda for the Finance Committee, so I'm going to try to go through these items, at a reasonable speed. If you have questions, of course, please, happy to answer those as we go. The 2020 Annual Financial Report, let me give a little bit of context. This is one that, interestingly enough, we've never really done this type of report until last year. Last year was the first time we came to the committee and gave a full year report on our financials. The reason we haven't done that in the past is because as we speak, we are right now in the very last stages of working with our external auditors to audit our financial statements. There's a meeting with the audit committee subcommittee on Thursday, and that's one of the final steps in order for us to have our audited financial statements. So in the past, for fear of interfering with the audit process, we really haven't shared financial information for the year. Last year was the first time that we decided to do this, and we my personal preference is to do it the way I'm going to do it right now, which is using a dashboard. I think using the dashboard, we're not going into the specific details of the figures that are not audited yet, but it gives you directors and the public a sense of where we ended the year financially. But I want to emphasize that all of these are unaudited figures. They're based on unaudited figures, and that the final audited financial statements will be available after we have the audit subcommittee, and they will be available here in the next coming weeks. With that said, 2020 was a very interesting year in many fronts. Of course, this is the understatement, I would say, of the year. COVID definitely threw us all into a loop. And you can see that here on retail revenue. Our retail revenue, which makes the bulk of the revenues for OPPD, was down. It was down significantly from our budgeted numbers. $52.7 million to be specific. Why is that? And I'm gonna talk about that in a little bit of detail here in the next couple of slides. We received less revenue from customer owners, but at the same time we also spent less money internally. So it was really interesting to see the drop in revenue primarily caused by COVID, but also it came with a commensurate reduction in expense, also from us not needing to generate as much power for our customer owners. Off-system revenue was also off, $26.3 million under budget. We sold, the value of the energy we sold into the market was $26.3 million lower than what we expected. Again, COVID affected not only us, but all of the counterparties that we interact with and we sell power to. So there was a lower demand for energy. Other income, on the other hand, that one increased. $32.6 million above budget. And I want to spend a little bit of time on this one. If you see here on the graph on Q1 and Q2, that light orange bar really explains the increase of other income, and that is investment income. And as I've said many times in the past, what happens is when interest rates drop, as they did right at the onset of the pandemic, the value of the securities we hold in our portfolios goes up. We're still expecting to get the same return, right? If we hold those securities to maturity, nothing really happens with those securities. But in the interim, what we call the mark-to-market value of our securities increased. And so that explains the majority of the increase in other income came through investment income, and it came in the form of mark-to-market. Not necessarily cash income we receive from those securities, but because the temporary value of those securities increased because the prevailing interest rates in the market were lower. Very similar to the same story we've been watching for the past couple of years. Moving to the right side of the dashboard, on operating and maintenance expense, those were slightly higher, slightly lower, $19.6 million under budget. Same with the fuel and purchase power amount. That was $44.7 million under budget. Same story. We're using less energy. It cost us less. We used less fuel to generate that energy. And so the drop in revenue, again, commensurate with the drop in expenses, was a relatively favorable thing for the utility. I want to call out that this is not by design. This is not by luck. This happened by design. This is something that I have to give credit to our board members and previous senior management teams who throughout the years have made sure that our cost structure aligns better with our revenue structure. So the variable parts of our cost structure better align with the variable elements of our revenue components. So in times like these, when revenues drop, our costs drop, not one-to-one, but commensurately. And so it helps us maintain this financial balance in years where we see these big changes like we saw in 2020. Can we go to the next slide, Mo, please? Actually, let me go back. I missed one box. I apologize. In the other expense piece, we ended up spending a little bit more than we had planned, and that's actually not a bad thing. Most of that is explained by decommissioning. It didn't necessarily cost us more. We actually accomplished more than what we had budgeted for. So this is, again, another shout out to the decommissioning team that throughout a lot of work in the middle of a pandemic, they were able to move a lot of the fuel onto dry cask and do a lot more work than we had planned. So that's actually a really good story on the other expense of why it came a little higher than expected. Next slide, please. Okay. Operating income was lower than budget. And what happens here is you can see both operating income and net income at the end of the year when we look at the year and we look at how many more dollars we may have that are above and beyond the 2 times debt service coverage metric that we have in the district. And by design, one of the things that we did was we removed revenue at the last day of the year to meet that 2 times that service coverage. That revenue today is provisioned for the decommissioning and benefits reserve account. However, the board will have an opportunity at some point in management to decide how do we use those revenues, especially in light of what happened about a month ago. But right now, it was all set aside and it's reserved for the decommissioning and benefits reserve account. So on purpose, by design, we ended up with a net income that was $74 million, a little bit higher than the budget of $65 million. And again, that's reflective of the relatively positive financial year we had in 2020. Our cash balance is very healthy. The budgeted amount was $351 million. We ended up with $366 million in cash. Part of this is because you can see that on the bottom box, we did not execute 100% of our capital program. So part of what we had planned to execute, we didn't execute it, and we ended up with higher levels of cash in our reserves. Let me talk about the capital piece. On the capital side, we executed a $197 million capital program, which is fantastic in my opinion. It included a lot of really good work, hard work from many parts of the organization. We continue to accomplish big projects, again, on big transmission projects and distribution. We continue to see a relatively large investment in our business technology, which is something that we've been focusing in the past 4 years. Why did we spend less than the budget amount? That has to do primarily because of Power with Purpose. As we've talked about this project in public meetings, Power with Purpose is a project that continues to happen right now. When we budgeted these amounts were budgeted in the summer of 2019. Right, for the 2020 spend. So there were a lot of assumptions, a lot of unknowns. And as the project moved along, the team, senior management, and the Power with Purpose team realized that it was better for us to wait and really not ended up spending all of that money in 2020. There will be more capital expenditures in 2021 associated with Power with Purpose as well. So that big variance has to do with the big projects and the volatility we have with those. I'm going to move on to the last slide, and then maybe we can have some questions, Mo. So this is a slide that we did not have last year, but I asked my team to put together this year, and this is really to show. I talked about how we received less retail revenues than budgeted, but I wanted to show where those retail revenues came from. So really interesting that on the top 2 boxes show residential megawatt hours and residential revenue. That one went up, and as myself and a bunch of other people, the majority of our customer owners, we ended up working from home. We ended up schooling from home. We ended up taking care of elders from home, doing telehealth from home. So we were using a lot more energy in our homes than usually we do. In any other year, usually the times between 9 a.m. and 5 p.m., the majority of people in homes are either at school or their place of work. The energy consumption in the residence typically is lower. That was not the case in 2020, and we can see here the increased consumption of megawatt hours, and consequently the residential revenues went up from 2019. It also increased from what we had budgeted for 2020, and it was $432 million, the actual residential revenue. Conversely, the other side of the coin, and this is something that we saw in 2020, and unfortunately we keep seeing in 2021, is a significant decline in consumption and revenue from commercial customers. As the pandemic really started taking effect on the economy, we saw commercial customers either curtail their usage by operating fewer hours, fewer days out of the week, and some of them, unfortunately, going out of business, right? Closing doors completely. And we are still seeing that. We're still carrying some of that effect in our community. the drop is significant. That's where we saw the biggest drop in in usage and in revenue. We all expect these to at some point reverse and see the economy start picking up again, but it's going to take some time, right? And I did want to show that here, that commercial revenues is the one that we saw the biggest drop. Industrial revenue at the bottom, that one is a little interesting because we did see some reduction in industrial revenue, reduction in industrial megawatt hours from a few of our large industrial customers. However, at the same time, there are a few other industrial customers who are busy building new infrastructure, building new facilities, and they are now taking also a lot more megawatt hours and paying additional revenues. So the net effect between existing industrial customers and relatively new industrial customers resulted in a slight from almost the amount of revenue we got in 2019. But I have to share that with you because it's not that industrial customers didn't experience any changes. Some did negatively, some did positively. The net effect is what you see on the charts. With that, that's a very high level overview of how we concluded the year. Overall, I would say 2020 was a challenging year on many fronts. Financially, 2020 was the perfect example of why having a fiscally healthy organization is important. It paid off in a year like 2020. We held steady. We were able to meet all of our days cash on hand metrics, debt service coverage ratios. We did well, considering all the other factors and considering how much this affected many people's lives and economies. OPPD came into this pandemic in a relatively solid position that allowed us to come out at the end of the year in a good place. Happy to take any questions or comments that you may have.
Director Kavanaugh, do you have a hand up? Oh, you don't, evidently. Thank you. Anybody else? Director Wagner.
Yeah, I'll ask a question. Can you help me understand on that industrial consumption? It's like a 1% decline versus the revenue is like maybe a 9% decline. Help me understand that.
That's a good question. It has to do with the different rates that some of our industrial customers use. Rate 261M is probably the biggest reason for that discrepancy between megawatt hours used and revenue charged. It's the different rates that customers choose to use that explain the difference here.
Okay. All right. So did we I guess see an industrial usage pattern difference than what we were anticipating? Is that like from a demand, like did the pandemic affect like industrial customers from a demand, like a total demand standpoint, that could be the difference there? Or
no, I think what we ended up seeing was very much as expected, and again I'm very careful about protecting privacy of our customer owners, so I can't tell you exactly which companies. But we did see some of our larger customers continue to meet their forecasts as expected. Again, some customers use different rates, right? Rate 261M is going to have different type of megawatt hours usage versus the revenue that we collect. We did see probably one of the surprises was that at the onset of the pandemic, we saw reduction in usage, not only from commercial customers, but we saw a little bit of that also from industrial customers. People were paring back their productions as they figure out how the pandemic was going to play out. We saw a little bit of that reduction in the spring and summer months. Eventually, it picked up in the latter part of the year, which is not the case for commercial. Commercial revenue did stay low throughout the year.
Yeah, Chair Wagner, I think it's really important that commercial and industrial are not indications of how those customers use their energy. Industrial revenue could be office buildings that have a high enough load that meet an industrial rate as we've classified it. So I would agree with Javier in that, where a lot of people were working from home in a variety of different facilities. Therefore, conditioning, heating, cooling, lighting just was not showing up in those large customer kind of operations. Multi-story, you can kind of guess who they might be that had people working from home during most of the pandemic and maybe still do today. So over.
Thank you.
Director Moody?
Javier, thank you for walking us through this. This is really helpful to see it at this scale. I like the reporting methodology that we've transitioned to over the last couple of years. So kudos to the team on pulling that together. My question, so naturally, the pandemic has put a lot of people in really difficult financial positions, and that's demonstrated by some of the data that we have around the number of customers that are behind and paying their bills, whether they be residential, commercial, or otherwise. Help me understand what the implications of that are on our financials for 2020. I'm trying to get a sense for magnitude, materiality, and what sort of an impact that's had on us.
Great question, Director Moody, and maybe I can call on I think Heather Siepkin or someone from the customer group if I need a little bit more information here. As you recall, the board approved a resolution to stop disconnects and waive late payment charges for a period of time. And I believe it was from April through July of last year. That certainly had an impact, a negative impact on our financials, but it was a positive impact for the people who needed it the most. So it did have an impact on our financials. I would say that the fact that the board reinstated late payment charges and disconnects in the July timeframe, it improved significantly the way we would have ended the year, but more so, in my personal and professional opinion, it improved the likelihood of those individual customers being able to catch up and pay debts that otherwise it would have accumulated a significant amount of debt if we had continued with those disconnects and those waivers. I'm not saying that wouldn't have been welcomed by customers, but I am hearing from other colleagues, other CFOs, other public power entities that have continued with those moratoriums, and now they are very concerned about the huge amount of debt that individual customers have accumulated and their ability to pay that back and to come back with a payment plan. I would say that financially for OPPD, it affected us, but I would say it's being able to work earlier with those customers who needed the assistance, connect them into the LIHEAP programs with Dollar Energy Fund. That was fantastic. We have seen a reduction, and Julie Comstock has shared this with the board in the past. We have seen a positive trend, meaning a reduction in the balances of arrears from customers back to levels that we had back in 2019. I'm not diminishing the need. I'm fully aware that there's a lot of need out there, and that the pandemic effects are still out there. Unemployment is still higher than what anybody would like it to be. But I would say the fiscally responsible actions, in my opinion, that the board took are helping those customers. I hope that answers the question.
Yeah, that's helpful. I appreciate that. That summary, and in particular, thank you for reinforcing the fact that we didn't just reinstate late payments, right, without help. There were many avenues by which we were able to point customers to assistance, so it wasn't as though we just stopped. But I appreciate understanding the extent to which we had a financial impact of that. So, yep, question answered. Thank you, Javier.
You're welcome.
Follow-up question by Director Mulhoff.
The write-offs significantly more than previous years. No, they were not significantly higher. They were around the same amount of write-offs, partially because because OPPD had the opportunity to take action earlier in the year and work with customer owners to prevent a larger amount of write-offs. They were high on the higher side, but not. I wouldn't qualify them as significantly more than previous years.
Very good. Thank you.
You're welcome.
Thanks, everybody. Are there any more questions, comments? Very good. CFO Fernandez.
Thank you, Director Yoder. I think we can move on to the retirement plan annual report. I'm going to be brief here, and I'm going to give an opportunity to Mr. Jeff Busek from Siegel Marco Advisors to come to the board as he always does every year and talk to us about the market. The reporting item here shows the market value of the retirement plan, the asset allocation. I'm going to steal a little bit of Jeff's thunder here, and I think you all experience the same thing as if you watch the news and if you have investments. 2020 was a roller coaster. We saw significant drops in performance in the second quarter of the year, followed by significant gains, all in all resulting in a relatively healthy market return, all things considered. So I'm gonna pass this on to Mr. Busek and happy to answer questions after his presentation. So Jeff.
Well, good morning, everybody. I'd like to say it's nice to see you, and I do see some of you, but not all of you. And I know there are a few new people attending this year, so welcome. And just by way of background, I'm the leading consultant at Siegel for the OPPD relationship. Keith Reynolds, who works with me, is also on the line. He's going to play a little color commentary as needed. It's interesting. My wife has been trying to sign us up for these vaccines, and I'll tell you what, it's easier to score a touchdown in some of the NFL games than it is to get in there. But this morning I was kind of thinking back about a year ago to where we were, and I remember driving home from the airport and hearing that the March Madness had been canceled, and that's when it kind of hit me that this thing was bigger than I thought it was, and lo and behold, that was just the tip of the iceberg. It got much worse. I will say when we got into the fall, there was a little bright spot when they said they were going to bring back college football and the NFL would play. But I will tell you, being a native of Pittsburgh, my alma mater, Pitt, and the Steelers, that excitement was rather short-lived. So here we are now in 2021. And coming out of this, at least it appears to be on the back end. If you'll turn to page 4, I'm just going to quickly go through the, so one more page. I'm sorry, Mo. Right there. I'll hit this real quickly because you already kind of mentioned. I mean, it was a roller coaster. When we got to the end of the first quarter, we saw numbers that we hadn't seen since 2008, 2009. But the context of it was very different. 2008, 2009 was a broken financial system. 2020 was a pandemic, and so while there was cause for concern, I think most of us thought this we can get past. We don't know when, but we know we can get out of it and get past. And lo and behold, we did. When you see across the board here, the markets were up pretty unanimously, with the lone exception of commodities, which suffered. GDP numbers set historic highs. They set historic lows. The equity markets ended up, in double-digit positive territory. Growth stocks, which had been dominant over value stocks for some time, continued that surge of outperformance. In fact, by the end of the year, the growth stocks had outperformed value by almost 40%. So that dominance is there. As we move into 2021, I will say that it looks like there might be a little bit of a turning point coming where value might start to do well. But as we go through the portfolio, you'll see we have exposure to both growth and value in the portfolio. So we benefited, from some of the growth exposure when we, got dampened. Our performance got dampened a little bit as a result of the value exposure there. I guess I'll leave this page by saying, as we look into 2021, I don't have a crystal ball. I don't know how we'll end up, but I have a feeling that we'll see positive numbers out of the equity markets. I'm not sure about the bond area. The Fed has continued to say they're going to keep short-term rates down where they are right now. It's basically zero, at least for another 2 years. But they are anticipating inflation coming back at about 2.5%, which is a little bit higher than they've been kind of targeting before. So we've seen the yield curve steepen. I would expect to see that continue as we move through 2021. And that will have a negative impact on longer maturity fixed income investments. So those are kind of my crystal ball thoughts and kind of a recap of 2020. So if we can turn to page 5 or the next page, we can take a look at where we were at the beginning of the year and where we were at the end. And that net gain of about $100 million in appreciation, again, was not something I would have thought we'd all been looking to see or having even a glimmer of hope of seeing at the end of the first quarter of last year. But again, the resiliency of the markets proved to help us out here. The next page, for those of you that are new, we have 2 objectives that we kind of look for, and one of them is to exceed the benchmark index net of investment management fees. So at the end of the day, what do we really have to spend when we pay our fees to the managers? And as you look across the numbers here, we're positive over the last couple of years, negative. But I would say overall, as you look across this table, and it is, I should tell you, it's a blending of net of fee numbers and gross of fee numbers. So those longer term numbers don't have the fees taken out of them. But I think the relative value, and when I say relative, that kind of difference of maybe 20, 30, 40 basis points either way is pretty, I think that's pretty common as we go out from left to right. So I think we're holding in relatively well with that first objective. The next page gives you the second objective that we're looking for, and that is to earn a rate of return ahead of inflation by 4%. And as you look across here, over the 10-year period, we've done that. We've earned 7.5%, which is well above the objective of 5 and 8. And then over a 20-year period, I'd say we're flat. We were at 6%. The objective was 6.1. So again, I think holding up relatively well to the objectives that we have there. Now, when we start to take a deeper dive and look a little granular on the next page, we can get into our domestic equity managers. So we have, I think stepping back a couple of years ago, we indexed some money in the portfolio across a couple of different asset classes with the goal being to get that exposure to reduce costs, which did save the plan quite a bit of money in management fees. But we did it in areas where we expect the outperformance of active management net of fees to be hard. So there's kind of a two-prong approach there. Let's get the fees down and get the exposure there and do it in areas where we'd be better off indexing versus having active management. And as you look across here, that State Street Russell 1000 is our core in our large cap area. As you look at the performance of the individual managers in 2020, Wellington outperformed their benchmark, did very well, ranked up very high in their peer group. And then as you look at Voya and LSV, you see a little bit of a different picture, both managers underperforming. And that's really to be expected given the way both managers invest money. Voya will not do very, very well in very strong growth-oriented environments. They tend to hold up better in down markets, which was one of the reasons they were selected and put in the portfolio. So this last year really was one of a momentum kind of orientation to the growth area of the market. And so they lagged as a result of that. LSV is a deep value manager. So when you look at the flavors of value, deep value are the managers that are really looking at out of favor stocks to put in the portfolio. They usually identify a catalyst in that company that's going to propel that stock back up into a market value that they've determined internally that the stock should be trading at. But in the scope of the way LSV does that, because there are various grades of those companies too in terms of quality, LSV tends to look for the higher quality names in those down and out companies, and those weren't the ones that did very, very well, even in value in 2020. So this out of favor, if you will, for LSV began back in about 2018. I will tell you the small cap area of the market, they were more adversely impacted than they were in their large cap area. They run money the same way, regardless of the market capitalization. So if it's a large cap value product, it's the same process as it is on small cap. But that issue that I mentioned before about the quality of companies was more pronounced in the small cap area than it was in the large cap, and that's the reason that they didn't do quite as well in the small cap. We still have confidence in both managers. They're still rated by our research group as recommended. And again, I guess I would just remind everybody that when we take on active risk, and by active risk here, the examples are the passive Russell 1000 and the active strategies with Wellington, Voya, and LSV. Whenever we take on that active risk, it doesn't matter who the manager is. At some point, they're going to underperform. And looking at Voya and LSV, I guess I would say that I'd probably be more alarmed, especially with LSV, if their performance looked better than it does, because that would have me scratching my head and wondering, are they doing something a little bit differently than maybe they portrayed when we were hired? So we have the domestic equity there. Now, next page gets us into the international markets, and the international markets obviously, suffered as ours did with some of the volatility. But as you look through here, AQR, the first firm here that you see, we put them on watch about a year ago. At the last meeting that Rick mentioned that we had, it was a decision was made to go ahead and move away from them. We had profiled a couple of firms for the committee to take a look at the meeting beforehand. So we're going to move ahead in a deeper dive with those organizations. And I would expect sometime within the next, probably within the next couple of months, we'll have identified who we want to move ahead with the replacement for AQR. Then when you look at OFI and Wells, they both did pretty well in terms of outperforming their benchmarks during 2020. And the new guy on the block here, Global Alpha, Lord Abbott was replaced last year because of performance and largely a lot of organizational changes that had happened. So we did a similar process that we're going to do for AQR and looked for a new firm, and this was the firm that we brought in as a result of that. So they're new, and you see across there, no numbers yet, but we will start to report on those later this year as their quarterly numbers come in. Fixed income, I mentioned before, was positive for the year, although there were some scary moments, just like the equity markets had. Again, we have some index money here. You see the two State Street portfolios, the one at the top and the one at the bottom, is tracking our indexes very well. Again, exposure at a low cost there. Reams had a phenomenal year. They really caught the wave at the right time. So they had been a little bit defensive in the first quarter, which obviously helped them. But then they had an overweight in corporates, higher quality corporates that actually helped them not only in the second quarter, but also in the fourth quarter. Corporates did well there as well. So when you look at their numbers, top decile performance within the universe rank there, and about a 10% outperformance for the index for the year. So very strong numbers from Reams. Excuse me. JP Morgan, did well as well. Well, longer term, you can see a little bit of a mixed bag there with them. They either matched or outpaced their benchmark for all the time frames that we see here. And finally, Neuberger and Berman, again, a little bit of mixed results versus their historical performance measurements. But again, active management, we don't expect every manager to outperform every year. So that blending that we have there, I think, helped us as you look back and say, okay, well, how did we do overall within our fixed income investments? And I think really Reams led the way there, but I think the other ones held up reasonably well as well. We also have some global fixed income and emerging market debt, which you'll see on the next page here. So we have two managers here, Colchester and Stone Harbor, and both did very, very well. and outperformed their benchmarks during the 2020 timeframe, and also did very well relative to their peer groups. They've been volatile over time. You can see different numbers as you look at it. For example, I'm kind of looking at a little closer. So if I appear like I'm straining my eyes, it's just I'm trying to make sure I get the right numbers here. But you can see, you know, where their numbers when you move left to right relative to peers. They will vacillate up and down within the peer group, and that's to be expected. But a good strong year out of both of those managers in the global fixed income and emerging market area. Excuse me. The next page is private real estate. Private real estate, you might remember, was new to the portfolio a couple of years ago. So we have both a core allocation there with the PGIM real estate, the PRISA fund, and a little bit of a specialized area with Harrison Street. So again, you know, reasonably good, strong results out of both of them. Harrison Street a little bit stronger just because of the niche that they play in. Is a little less diversified than the PRISA fund is. So they did a little bit better during the calendar year. So let's end now on the last page here and kind of take a step back and, you know, revisit what I just said. So the total fund was up net of fees almost 13% for that calendar year. Assets up over 100 million. We ended the year at almost 1.2 billion in total. It did outperform the policy index by 20 basis points in 2020 net of fees. And longer term results, you know, we continue to think are doing well. Just to give you a little bit of a look into what we're going to be doing in 2021, I did mention the AQR surge that we'll be doing. Another thing that we'll be doing, which we do about every 4 or 5 years, is a formal asset liability study. So we'll be going through that with the committee in the coming months. We're looking at where we are right now in terms of the asset allocation. How does that, you know, affect different metrics that we're going to look at? Should things do well? Should things not do well? We'll look at some other asset classes and maybe some other allocations, and you know, you'll probably hear more from us later in the year as we get through that process. So those are all my comments for today. I'm happy to answer any questions anybody might have, either about the markets or about the pension fund as a whole.
Thank you very much, Jeffrey. I do see a question from Director Moody.
Sorry, maybe I missed this. The asset liability study, how frequently do we do that? Is that
about every 4 to 5 years?
4 to 5 years? Okay, great. And that results expected later sometime this year, is that right?
That's right.
Okay. That's my question though. I'll just make a quick comment, Jeffrey. I remember a year ago as well. And I remember asking you the question when you were presenting to us, what are the potential implications of the pandemic? And you said, you know, I don't anticipate anything negative over the course of the year. And I was blown away by that response, and I was extraordinarily skeptical. But in hindsight, despite the dip, you were right.
Yeah, someone has to bet that way, right?
Yeah. So anyway, I just in reflecting on that, I was fascinated by just how on point you were with that projection.
Well, I really think it went back to what I said at the beginning, which was this was not a broken financial system; it was a pandemic, and I'm still, you know, the committee's heard me, and other people on other committees within OPEB have heard me, but I would say that I still believe the glass is half full. So I'm not normally an optimist, but I do think, you know, we're in better shape than maybe some people think. Just to give you an example, the GDP estimates for 2021 have gone from 4.25% closer to 5% now. So I'm not the only one that, you know, necessarily thinking optimistically. But like I said, if I had bet that way in 2020, you might not see me here today, right?
Fair enough. I'm complete. Thank you.
Sure.
Thank you, Director Moody. Director Kavanaugh. Mike, if you're talking, I can't hear you.
You hear me now?
I can hear you now.
I'm sorry, I have a little technical issues. I'm not sure if this question would be more appropriate for Jeffrey or for Javier, but I was just interested to see where we stand now as far as the pension system itself, percent of being funded as opposed to a year ago this time.
Mike, that's a great question. If you give me about 20 minutes, we'll get that on SE14, and I'll dive a little bit deeper on those details.
Sounds good. Thank you.
I don't see any other questions. Other questions for Jeffrey or Javier on this? Just a quick reminder, if you can help me with this, Javier. And Jeffrey, you mentioned monitoring the managers. There has to be a certain amount of performance or non-performance. Can you talk about the strategy there that is codified, I guess, really by the oversight committee?
Certainly, just at a high level, I think this is something that we rely on two types of factors. One is quantitative performance, and the other one is qualitative. On the quantitative side, as Jeff mentioned earlier, we do track performance from managers, not just on a one-year basis, but on a multi-year basis. And we know that depending on the investment goals for each part of the portfolio, we know that there will be years where economic conditions would tell you that some managers wouldn't do well, and some other conditions where the same manager will do really well. And that's part of the diversification of the portfolio, trying to make sure that we have a good portfolio balancing. So a poor performance in and of itself is not necessarily the reason for us to look at replacing a manager. However, a consistent poor performance in years where we should have expected a different type of performance, comparing that to benchmarks, really raises that flag. This is where we engage in deep conversations, and we rely a lot on both Keith and Jeff, who are here on the camera, to provide us with that qualitative side of things. So to supplement the quantitative analysis of investment managers' returns to their expertise, empirical expertise on who's managing the firm, are there issues with the firm, and do we have variables that are showing us that, you know, we probably should be looking a little closer into those firms and looking at replacing those firms. That's what we've done in the past. We have put investment managers on watch. Some investment managers have come out of watch and they have, you know, brought their performance back, and they're still in our portfolio. Some haven't. We talked about Lord Abbott, for example, that we replaced last year. The conversation started about 18 months ago. We talked with them, we debated as a group. Eventually, we brought in Siegel Mark, who helped us bring candidates to replace that investment firm. We held interviews. This is probably one of the last in-person interviews we had last year. We had a couple of our board members. I remember Director Bogner, Director Mulhoff. You were part of some of those discussions. We bring members of the Finance Committee are welcome to attend. Ultimately, it is the Trust Management Committee. I chair that, and I have Mark Sedke helping me with that. And we have 3 directors, OPPD directors of Treasury, Accounting, and Total Rewards, make those decisions. When we replace someone, we will bring that to the board. The board has to take action. We'll show you why we're replacing who we're replacing and who we're replacing them with. So it's a more formal process. The board will always hear about these. It's a big deal. You know, we're asking these managers, investment managers, to manage tens or hundreds of millions of dollars of our pension funds, and we take this job very seriously, and I want to make sure that we're always acting in a good fiduciary capability.
Really
Keith, Jeff, anything that I missed?
No, I was just going to add, Javier makes a good point that there is a quantitative and a qualitative, and I would say in the context of both Lord Abbott and AQR, it was both of those elements that kind of made the decision for us. There were organizational issues at both firms with these products, as well as a prolonged period of underperformance. So, as Javier mentioned, the watch list is a way to document an action taken, and we've put managers, as he said before, on that have come out. Those are usually, I won't say always, but usually the ones that come out are performance related. If the ones like Lord Abbott and AQR with their organizational issues on top of that. Those are usually ones that are going to be, I think, the odds favor replacement more than seeing them come out of that.
Wonderful. Thank you very much for that summary and putting a fine point on that. This is incredibly important stuff. And it's a good reminder for the public and for me as well as new board members. So thank you very much.
Sure thing.
I don't see any other hands up. I hear no comments. So can we move to the next topic?
Certainly, Director Yoder, I'm going to talk about a few other funds just as important as the pension fund, and this is important for us to review. This is a 401k and 457 retirement savings plan annual report. This one is a voluntary, where employees make voluntary contributions, tax deferred for 401k or 457 plan. It is up to each employee to decide how much they contribute to those plans, and that's defined contributions into the plan. OPPD does match some of those contributions up to certain limits. I am very, very pleased and happy to report that this is not a change. This has happened for many, many years, but we have the rate of participation of our employees is approximately 97%. Of our active employees participate in the 401k 457 plan. This is outstanding by any measure. We talked to folks at Seagull Market, we talk to folks at Fidelity and others that help us with advising, and it is certainly on the outlier side. We have a lot of OPPD employees take advantage of this plan, which is music to my ears. It's good financial, fiscal preparation for retirement. What I want to talk about here today is the plan. Employees contributed about $14 million to the plan, and OPPD's matching contributions were $5.9 million for both plans, 401k and 457. We're describing them as a combined. The total plan balance at the end of the year was $622 million. 2 years ago, we broke the $500 million mark, and we continue to add to that plan. Part of it is contributions, but also having a relatively positive market that Jeff mentioned helped. On these one, same in a similar way than with the pension plan, we monitor not only investment managers, but we monitor the adequacy of investment vehicles that we offer to our employees. Again, because this is a voluntary selection from employees, we want to make sure that we are offering a healthy variety of investment vehicles for our employees to make investments on. You can see here the list that we have today. They have, our employees have opportunities to invest in domestic equity funds, international equity, domestic fixed income, international fixed income, and we have other funds. On the other funds, I do want to call out, we have targeted investment strategy funds, and those became a lot more popular a few years ago when employees can choose, instead of choosing specific investment categories, they select a fund that matches with their anticipated date of retirement. So we have targeted funds for 30 years, 35 years, 20, 25 years, and you let then expert portfolio managers manage that depending on your horizon of retirement. And you can see here, I'm not going to go into all the details, but it's the performance was very similar to what Jeff Busek just described on the pension plan. So very, very, very happy with the participation of our employees and with the results of the plan. Happy to answer any questions here.
I see none. Let's keep moving.
Okay. The other group of funds are the OPEB trusts annual report. And you hear me emphasize trusts as in plural. We have two different trusts, OPEB A and OPEB B. OPEB A, and they're all looking at funding medical expenses. As you can see here, the OPEB A is designated for employees hired prior to 2008. OPEB B is employees hired after December 31 of 2007. The size of the funds varies. It's very different. OPEB-A fund ended the year with $183 million, $183.6 million at the end of 2020. OPEB-B, reading it here, ended up with 6.1. So very different sizes because the liability is very different. What OPEB-A is designed to cover is wider, has a wider amount of benefits that employees hired before 2008 will receive. OPEB-B is sized appropriately for the type of liabilities that OPPD has to cover for employees hired after 2007. Both funds earned a healthy rate of return. They have slightly different compositions. So Director Moody, you asked about the asset liability study. We do this every 5 years. We're actually going to do one for the pension fund coming up here in this year. The OPEB funds, we ran an asset liability study 2 years ago. And so it helped us, we look at the composition of our assets compared to the liabilities we have, and we rebalance if there's a need to rebalance. The OPEB-A trust fund is balanced specifically to meet the liabilities of that fund, hence the different earnings. So that fund earned 15.1% in 2020. OPEB-B has probably a little longer horizon. It's for more recent employees that the fund is not expected to have liabilities as early as OPEB-A. The investment vehicles that we choose for the OPEB-B fund have less risk and have more stability because we have a longer investment period. The earnings on that fund were 10.3% for 2020. Same investment management oversight applies that we have on the pension side. It's the same one that we have on the OPEB side. In fact, on many of the meetings we have where we discuss our pension plan, we also discuss OPEB. We oftentimes also leverage relationships we have with investment managers on the pension side and on the OPEB side, both A and B. For instance, OPEB-B is a relatively small plan, relatively small, $6 million compared to over $1 billion in the pension plan. So sometimes volume of investments makes a difference in terms of which type of investment managers we can access, what type of fees we can access. So I think having this strategic discussion helps us so that we can get the best results for all of our funds by leveraging good relationships with managers. That's all I have to share with OPEB-A and OPEB-B, unless there are any questions.
I don't hear anything and I see no hands. So let's move on.
It looks like Director Spurgeon has a question.
I'm sorry. Thank you. Director Spurgeon.
Thank you. I couldn't find my hand soon enough. Just a curiosity. I noticed in your report that I believe it's OPEB-B, the employees made no contributions to that plan. I'm curious why. Is that accurate?
I'm gonna call a friend here, Mr. Thurber. Are you on the line? I think it has to do with the balance of the fund and the liability of the fund, but Mr. Thurber can probably give you a more accurate technical answer.
Yes, thank you. I am on the line. With OPEB-B, we think of it as a cash balance plan that the district pays for employees hired after 2008 and longer. And so there is not the way this plan was set up and the trust was set up, there is not an employee contribution to it. It's all a district contribution. And so with OPEB-A, the contributions there are really essentially the deductibles or the medical prepayments that are made by employees that have retired and are part of our medical plan. There is with OPEB-B, you're given a lump sum, so there's no contribution that you make to the plan. So that would be typical with this kind of a plan going forward.
Thank you.
You bet.
Other questions? Give another pause for hand raising, and I think we're good. Javier?
Thank you, Director Yoder. So the next item is the SD14 Retirement Plan Funding Monitoring Report. Let me preface these really quickly, because we just spent the past 20 minutes mostly talking about earnings. And a good way I have to, at least in my mind, to explain what I'm about to talk about here is if you follow a very simple formula. I'm going to simplify these, so forgive me for that. But it's a formula that says contributions plus earnings equal disbursements. Very simple. In the long term, contributions we make into a plan, into the retirement plan, plus earnings made throughout the life of the plan have to equal all the disbursements that we have to make. What we just discussed and heard from our experts in Siegel Marco here in the past 20 minutes has a lot more to do with the earnings side of things. I'm going to talk about earnings here a little bit, but really we really haven't talked a lot about the contributions or the disbursements, and that's what I plan to discuss here in just a few minutes. I'm not going to read this out loud. This is exactly the language that we have with SD14. I do plan to touch on each one of the bullet points below to demonstrate compliance with the strategic directive. So the first one, the national recognized actuarial firm should be utilized to perform the analysis. We have been using Aon, formerly known as Aon Hewitt, as our actuary to help us calculate, analyze our pension plan liabilities and our funding requirements. These are complicated calculations that we obviously don't want to do ourselves, so we have a nationally recognized firm that has been doing that for us for many years. Per the policy, OPPD, every single year, this is something that I am very proud of, and it often goes unnoticed. OPPD every single year has funded the amount determined by the annual required contribution by the actuary. Now, let me emphasize this. This is not legally binding. There are other governmental entities who, for other reasons, for fiscal reasons, they may not afford, they may not have the funds to fund all of the required contributions. OPPD every single year has contributed 100% of the annually required contributions to the plan. And this is not, it's not easy. You can see here the increases have been significant since 2016. We are now projecting to contribute $10 million more in 2021 than we were contributing in 2016 for a variety of reasons I'm going to touch on here shortly. But I want to emphasize that our commitment to funding the plan has always been there, and it's one of the pillars of our financial structure at OPPD. I oftentimes get questions from employees saying, hey, are we slacking on our contributions? And my response is no. We are contributing every penny that we're required to contribute into the plan every year. Next slide, please. Okay, I think you skipped one slide. Mo, can you go back? There you go. The one that has a 7%.
I think we're off the slide.
We're off a slide. Okay, can you move on to, there you go.
Sorry about that.
That's okay. So here's another important variable, and this has to do, this is on that formula of contributions plus earnings equals disbursements. This has to do with earnings. The discount rate is an incredibly important assumption in every pension plan. And it has very little to do with current earnings, although, current earnings, I'm happy to hear from Mr. Busek that, we were at almost 13% of annual earnings net of fees. It has a lot more to do with future earnings. Our estimates for how much the plan is going to earn on an annual basis for the next 30, 40 years. That is really the important decision, because any change in the discount rate, it will have an effect year over year, but it will have a huge effect when you look at the compound effect of those assumed earnings over decades. OPPD currently, and you can see it's a boring graph because it's been 7% since 2016. It used to be 7.75%, 7.75% prior to 2016. I believe in 2014, it was 7.75%. What OPPD did, and we work with our investment advisors and our actuaries, we look at the future, at the projections and forecasts of what the market is going to return in the next few decades. There is an incentive for me and for a lot of my colleagues to be conservative, right? Not to assume that we will earn higher rates of return than what we actually will end up assuming. So we have been on the conservative side. We will lower the discount rate from 7.75 to 7%. And when I say we, it's really the board makes that decision. At some point, we will bring a recommendation to the board to change that rate. What lowering the rate does, it basically says you cannot count on earnings going forward as much as you used to count on them. So the earnings component of that three-part formula is you can count on it less, which means that we have to then contribute more to make up for those investments that may or may not come in the future. Every time there's a lowering of the discount rate, what that does is automatically it tells the plan will be funded at a lower rate because we are counting on fewer investment earnings. The other effect of that is it requires OPPD and potentially employees to increase the funding we have to put up front to make up for those earnings that may or may not happen in the future. So far, 7% has continued to be the rate that has been recommended to management. We haven't changed that. But if you remember one of the graphs that Jeff showed on his presentation, the one that has our annual earnings compared to the inflation plus 4%, we have been above that inflation for plus 4%. But if you look at the trend of the actual returns, it was downward sloping. So that's something that we are keeping close attention to. At some point, there might be a recommendation for OPPD to lower the discount rate if our investment consultants agree. And when that happens, two things will happen as I described. We will have to put in more money as contributions to the plan, and our funding status will drop until that time when we can actually make up for the lower assumed earnings into the future. I want to call out one often mistaken assumption, which is when we lower our discount rate, does that mean that the plan loses money right away? And the answer is no. What it means is that we are counting less on future earnings, which I think, again, it's a fantastic call for action for the plan funders, because it forces us to make more contributions, be more fiscally responsible. If earnings end up being higher than the discount rate, great, we'll achieve funding faster, but we don't want to count on an assumed earnings rate that is not in alignment with what we're seeing in the market. There's probably a lot more information that you probably wanted to get on the discount rate, but I think it's a very, very important variable, and I want to make sure that I cover that one enough. We can move on, Mo. One more. There you go. Okay, so these tables shows the different things. Three main metrics. One is the funded ratio of the plan. The other one is the discount rate, and then the retirement fund return. You can see the evolution of those metrics throughout time. Let me start with the funded ratio. This is basically saying, as of today, what is the value of the assets we have in the plan today compared to the present value of the future liabilities we will have in the next few decades. That value today is 68.9%. This is one of the values that raises eyebrows and some concern from employees saying, so you're telling me we don't have enough money today to make all of our payments? And the answer is yes, that is true. However, not all of our payments are due today either, right? We have an actuary who helps us assess when our payments are due. And we have a plan, very clear plan in place to make significant contributions to the plan so that we can close this gap from 68.9% all the way to 100% at some point in the future. That point in the future, we know per our policy that we should achieve a pretty high degree of funding, upwards of or around 95%, I would say, by the 2034 timeframe. This has to do with a decision that the board made in 2014 that allowed the plan to make a 20-year amortization of the unfunded actuarial liability from 2015 all the way through 2034. So that's a 20-year amortization period. That's why I'm saying that in 2034, based on our funding pattern, we should get to a place where we are significantly funded. There have been more losses or increases to the unfunded liability since 2014, and those also have a 20-year amortization period. The discount rate hasn't changed on this table. The retirement fund return has changed. The number that you see in 2020, the 19%, that corresponds to the period as of January 1 of 2020. So what you just heard Jeff Busek talk about, the almost 13% we received for 2020, that will be reported as the earnings rate that will be used for the 2021 period. So there's a 1-year lag on that metric. Now, I talked at length about the discount rate and the effects that has on the funded ratio. Let me talk about a couple of other factors that really affect the funded ratio. Let's assume all else being equal, discount rate continues to be the same, retirement fund returns continue to be the same. The funded ratio could change if, going back to that formula, contributions plus earnings equals disbursements. Let's talk about the disbursement side of things for a moment. On the disbursement side, what could cause our disbursements to increase or decrease? Well, a couple of things. Probably the most important one is how long our retirees and plan participants are expected to live. This is an uncomfortable topic because we don't like to talk about mortality or people dying, but it is an important assumption in the plan. As we all have access to better healthcare and better preventive care, what we have seen in the past is that mortality rates, mortality tables have been updated to reflect the fact that our plan participants are living longer than when we previously expected them to live. For plan participants who were employed by OPPD prior to 2013, that means that when they retire, they have the choice to receive a monthly payment until the day they die or until the day their spouse dies. So when mortality tables are updated, all of a sudden the disbursement side of that equation increases, which means that the funded ratio of the plan decreases. All for the right reasons, right? Our people are living longer, which is great. But that means that we have to put in more money up front or make up for that with additional earnings to match that disbursement. The other side, and you can see here, FCS for Cajon Station, that was a big decision for the district. And I don't want to just call out for Cajon. It's any personnel decision. When the district makes big changes in the number of people employed or eligible for the plan participation, that affects the disbursement side of the equation. In this case, we have been updating the plan with assumptions on how Fort Calhoun decommissioning will continue to move forward, how long employees will be with the district, and how long will they accrue benefits under the pension plan. Lots of different variables that change, and we're actively working with our actuary to make sure that we are fiscally responsible, that we are assuming a conservative rate of return, we're assuming conservative mortality tables, And again, very, very important as we plan every single year for our corporate operating plan is make sure that we have enough money to make every single penny of that annual required contribution. I've talked a lot, but it's a lot of information trying to pack it in a very concise manner here. Hopefully I've done an okay job here. This is the last slide. The next slide is the recommendation that the Finance Committee has reviewed and accepted this report, and it will be presented for your consideration on Thursday for a vote. And with that, I'll be happy to answer any questions that you may have.
Does anyone have any questions? This is an action item, as Javier just said. I do see Director Kavanaugh has his hand raised.
Javier, that's good news, and it's certainly commendable that you take the conservative route in determining the discount rate. I realize there's other public funds in this area that aren't quite that conservative. When any annual contributions the district makes to the fund, do you determine that on an annual basis, or do you look at it quarterly, or how do you determine that, or do you pay in monthly? How do you arrive at that at that determination?
That's a great question, Director Kavanaugh. So both. We looked at it on an annual basis. From a budgeting perspective, we need to know at some point the pencils up from a budget perspective. We have every year around the August timeframe, we get a report from Aon that we use as a basis for funding for budgeting for the next year. However, things happen sometimes halfway through the year. And so throughout the year, we are in constant communication with our actuaries. And if there are changes that we need to make halfway through the year, we adjust those payments halfway through the year. Sometimes those adjustments are increasing in funding, sometimes they're decreasing in funding, but we don't wait a full year, a full cycle before we make changes. We're constantly trying to make those changes. Another important aspect, and I'm getting down into the technical aspects here, but we don't make one single payment. We actually make monthly payments into the plan, which works in our favor, because then those funds start earning earnings earlier in the year as opposed to waiting for a one-time deposit. It diversifies your investments. It's a dollar cost averaging principle, but it helps us make those deposits every month. I hope that answers your question.
It does, because I was thinking it's a pretty significant amount of money to put in there, and obviously timing can come into play if you did it on an annual basis. I just wasn't sure on that. Thanks a lot, Javier. Sounds good.
You're welcome.
Thank you for your question, Director Kavanaugh. Director Moody?
Yes, I think what is a materiality question on the disbursement. So Javier, you kind of touched on a couple different things that would drive the disbursement calculation, right? Mortalities, big changes in employee positions. You mentioned the 4 Calhoun stations. So perhaps this is way too weeds, but I'm just kind of curious about which are the big driving factors for pushing disbursements either up or down. Is it the mortality tables? Is that one of the big key drivers? Is it employee wages? Is it some of these big changes that you talked? Is there something that stands out as a really material driver, or a couple things, or is it just kind of all over the board? That makes sense?
Yeah, it makes sense. And so, yes, the mortality tables are a significant change. Because if you think about the compounding effect of a mortality table update, right, an employee or a set of employees living out longer, 2 or 3 years out longer, it does compound into a significantly higher liability on the other side of the equation. Mm-hmm. All for good reasons, but it has that effect. The employee base piece, it's not a big component, because as we lose employees, we also gain employees. So those inflows and outflows of employees usually net out each other, unless you have a significant decision like the 4 Calhoun decision. That one is significant, and that's what we called it out. Mm-hmm. The other piece, and again, I think you're referring to the disbursement side of the equation. Annual earnings have a huge effect. But from the disbursement perspective, one thing that changes the liability is how much are we paying on the other end. Not only how long are people living, but the dollar amount of those checks. And I know this is something that has been discussed in the past about making changes, increasing to those checks going out. That would have probably the biggest effect on increasing that liability.
Mm-hmm.
I don't mention that here because that is the district has done that in the past on a one-off basis. You know, it's not a liability for the district. The board has chosen to do that, you know, once, you know, in a while in the past. Mortality tables, we don't have a choice, right? When the mortality table is updated, we have to adopt it. These increases in payments, you know, they're not part of the benefit packet. If and when those would be considered, that would increase the liability significantly more than a mortality table, I would say. The details, of course, depending on how much that increase is, but that has the potential of increasing the liability significantly, therefore lowering the funded ratio significantly.
Right, right. Okay. All right. That was helpful. Thank you.
You're welcome.
Thank you, Director Moody. I don't see any other hands raised, and this is your opportunity. We haven't decided yet on whether this is going on the consent agenda or not. That happens later in this meeting. But if it does, then you should be asking your questions now. I guess my thought on that is, since it has to deal with the retirement plan and employees, we might want to move it to its own. But I'm open for discussion on that at the appropriate time. Okay, nothing else. To commercial paper, yeah, Javier.
Yes. I'll go on this quickly. I'm trying to be mindful of time here. So commercial paper program, this is probably not new to the majority of board members because we talked about these a couple of years ago. But I'll go over the basics here quickly, just so that we're on the same page. Commercial paper program is established in 1983. We've had it for many years. It is a financing tool that we have. You know, in addition to us, the district issuing long-term fixed rate debt to fund projects, capital projects. There is a way for us to also access short-term variable rate paper. That could be in the form of loans, of variable rate demand obligations, or in this case, commercial paper. Commercial paper has maturities anywhere from, you know, a few days all the way out to 270 days, where we issue debt for 30 days, let's say, or 60 days. And then we have remarketing agents or banking agents that when those maturities come due, they usually look out for other investors who are willing to invest on that paper, and they roll it over. So it's a way for OPPD to access capital funds and take advantage of short-term rates that are reset on a more variable basis. We, in 2019, 2020, well, in 2019, the board approved a resolution to authorize us increasing the amount of the program from 150 million to 250 million. We completed that increase in February of 2020. We've had fantastic results with that program. I'm going to talk about the risks here in a moment, but what we ended up doing is, with the addition from 150 to 250 million dollars, what we did is we used those funds to extinguish long-term higher interest rate debt. At the time, we thought that the savings were going to be about 41 million dollars by extinguishing long-term high interest rate debt and replacing that with short-term lower interest rate debt. The actual results tell us that the district has saved upwards of 70 million. And that is because short-term rates have continued to decline, and we're borrowing at really low interest rates. So the program has worked really well for OPPD and customer owners, and I'm very proud of the team who monitors and manages this program. We're going to ask the board to approve yet another increase of the program to 350 million. And I'm going to talk about that here in a minute of why the need and the risks that we have and how we're mitigating those risks here in a few slides. Mo, can you move on to the next slide, please? Okay, so the variable rate model, the VRD model, we have two very important metrics that we use to monitor the risk of OPPD. One is we want to make sure that we don't have too much of our debt portfolio is variable rate debt. Like when you have too much of your debt portfolio being variable debt rate, you are more exposed to changes in interest rates, and that could be a really bad thing when interest rates starts to rise. So having the size of a portfolio that is commensurate with your overall portfolio is important. That is the second bullet point in there, that rating agencies and financial advisors continue to tell us that 20% is around the recommended percentage of your total debt that should be variable rate debt, or in this case, commercial paper debt. About 20%, no more than 20%. Today, that amount would be about 294 million. We have 250, so we have some capacity to increase that to about $294 million. If the board approved it and if we had the opportunity, that would be the amount that we would have available. The other piece is the interest piece. So we have an asset liability model at OPPD. We have cash investments. I shouldn't say cash, but we have liquid investments in different securities, and we have a debt portfolio that has a variable rate interest rate. So variable rate earnings rate on our investments has to be matched with a variable interest rate on our commercial paper program. If interest rates, short-term interest rates go up, our short-term earnings go up, but also our short interest expense goes up. Conversely, when those things go down, so they move in tandem. A conservative measure that we have implemented at OPPD is that the interest earnings at all times have to be at least 1.5 times larger than the interest expense on the commercial side, so that we're always tracking the movement of variable interest earnings and variable interest expense, but we always have that margin of 1.5 times the interest expense. Our current coverage is very healthy. Our forecast is for interest earnings to be 3.8 times the size of our interest expense. So this is not really a limiting factor today, but it is one that we keep close attention to because those things could change. So we're not planning on changing these. These metrics have worked really well. We have discussed these metrics with our financial advisors, with our rating agencies. They're comfortable with them. If the board chooses to approve that increase to the commercial paper program, we would continue to hold these metrics up. Next slide, please. Okay, so here's a risk. This all sounds great, and it is great, but the risk is the commercial paper program basically says we are going to issue debt that is due in 30 days or in 60 days, right? We issue debt, someone else buys that debt instrument, we get the cash, and 30 days later we have to pay that investor back for what they lend us. As I mentioned, we have banking institutions that help us remarket that commercial paper and find other investors that are willing to roll over those commercial paper maturities. In the extreme event that there's a market disruption like we've seen in 2008 or in other times in this country, where liquidity dries up. Let's assume that there are no one interested in buying commercial paper for whatever reason in the economy. Well, at that point, 30 days go by, we would have to pay that investor off, right? When the maturity is due, and then we have to pay that debt off. That is the biggest risk, right? If OPPD doesn't have enough cash, enough liquidity on the other hand, if we are ever called to pay those commercial paper maturities due, we may be in trouble. So one of the things that OPPD has done for many, many years is we have dedicated a line of credit that is dedicated exclusively to back the amount of commercial paper we have outstanding. It costs us and it costs our ratepayers, it costs money to have that line of credit available. We don't touch it. It's ready to be deployed, but it is a fantastic risk mitigation tool. Should this situation appear, we would have the ability to then draw from that line of credit and meet the demand to redeem our commercial paper. That is the way that we mitigate these. I'm very proud. This is something that Mr. Thurber led many years ago at the district, and I can tell you not all issuers of commercial paper have these dedicated line of credit backing their programs. Ours is unique in that way. I would say it's strong. If the board approves the increase of the commercial paper program to $350 million, we would only do that as long as we can also increase the dedicated line of credit to match the amount of outstanding on the commercial paper side. All in all, again, the commercial paper program has continued to save a lot of money, again, upwards of $70 million to our customer owners. So I think it's a great tool to have. We'll move to the next slide, please. Okay, so that's the commercial paper program. Why the increase? Okay, we are 2021 is a busy year. We have Power with Purpose. We have a lot of big investments, capital investments ahead of us. We are looking. Part of our corporate operating plan includes OPPD issuing debt to fund our capital program. As we're looking at issuing debt, we're looking at all instruments we have to issue debt and fund infrastructure. One of those tools is our commercial paper. In an effort for us to take advantage of low interest rates and have a diverse portfolio of debt outstanding, our intention would be to increase the additional the current commercial paper program by $100 million and be able to take advantage of really low interest rates we have today. We have good liquidity in the district. We can issue some of our debt that we need to issue as commercial paper, and we would likely also issue long-term fixed rate debt into the future. At some point, once the investments are completed, we will evaluate the conditions, market conditions, and we may convert some of this commercial paper into long-term debt if the market conditions are favorable. So that this is again adding another tool to our toolbox to issue the same amount of debt that we were planning to issue per the budget, but it allows us to issue that at a really attractive interest rate. If you look at where short-term interest rates, we're paying a few basis points for that debt compared to upwards of 200 or 300 basis points if we were to pay long-term interest rates on our long-term debt. So that's a reason why we're coming to the board. We're planning on coming to the board with this proposal to add that extra liquidity tool for Power with Purpose and infrastructure investments. However, we are bringing these to the board also earlier because, and I'm going to talk about the polar vortex here in a minute. We don't have all the final numbers. We're still going through reviews, settlements. We're working with SPP. Haven't been able to share a lot about the financial effects of the polar vortex. Again, it's complicated, lots of settlements that still need to be defined. However, we do know that part of that process includes large outflows of cash, followed by large inflows of cash as a result of this polar vortex week that we had. This puts a little bit more pressure on our liquidity. Again, I don't want to sound alarmist at all, but we do have large cash outflows followed by large cash inflows, and the timing of those are not always ideal. They don't happen the same day, and they don't necessarily net each other. So having this additional tool is important, is valuable. If we have to use it to inject liquidity into the district, this is it is the lowest cost, the easiest way for us to inject that liquidity. As of today, talking to my treasury team, we don't believe we will need it. We have enough adequate ample liquidity in the district to withstand all of these cash flows and inflows. So that's really, really good news, and something that I'm proud of, our financial condition. However, it's always important to have this additional tool should we need it. For example, if we have to make a payment that is larger than we expected, instead of us having to liquidate a security that we have in one of our investment funds that may cost a lot of money to liquidate, and we may lose earnings on that piece, it might be more advantageous and cheaper for us to issue commercial paper, meet that liquidity constraint without having to liquidate securities early and really maintaining the value for our customer owners. So that's the reason why we're bringing this up earlier. We were planning on doing this sometime around the May timeframe. We're bringing it to the board in March, again, for this added tool or the potential need that we may have to fund liquidity for payments we have coming up here. And end of March and early April are our lowest points in the year for cash. We usually have big debt payments that happen in February. We have pilot payments that happen in April. So this is a good opportunity for us to really have more tools for that liquidity. I have a question on the panel. What is our cash on hand today? Again, unaudited. This is as of February, but I believe that our cash on hand towards the end, not today. Today is not that important, but I think towards the end of April, which is that important time frame. End of March, excuse me, beginning of April. We're looking at having cash on hand in excess of 150 days, 150, 160 days. So healthy days cash, even at our lowest point, which is again not concerning, but I think it's important for us to have this additional tool that would allow us to have that additional liquidity at favorable rates without having to liquidate securities if we don't have to. I hope that answers your question, Director Moody.
It looks like Director Moody has a follow-up question. Go ahead.
Yeah, I do. So Javier, thank you for walking us through this. This is admittedly for a finance major. That's 20 years in the rearview mirror. So this is pretty complicated stuff, and I want to make sure that I understand what you're asking us to commit to here. So correct me if I'm wrong. We're at 250 million today. You're asking for an increase to 350 million. Is that right?
Yes, that is correct.
Okay.
I am not asking for an increase to the amount of debt that was, so the board approved a corporate operating plan last year. It had a financing plan in there. So this is not changing that. It's just adding a different tool that would supplement long-term with short-term debt. But yes, the idea is to increase the authorization. Once, if the board authorizes these, it doesn't mean that we will immediately increase the commercial paper program. We will only do that if the opportunity presents itself. As we increase the dollar amount of our debt portfolio, we may have an opportunity to take advantage of that commercial paper. The metrics that I described still govern, and I feel very comfortable with those metrics, really keeping the program healthy.
Yeah, so that's helpful. And as you described, this gives you the ability to go up, but it doesn't mean that it triggers automatically anything that goes up, right? And if and when that goes up, is that also the time in which you increase what my simple mind is thinking about is the insurance policy that we have? I mean, the way that you described that risk mitigation to me felt almost just like an insurance policy, right? Where we don't need it unless it kicks in, but we're paying a premium in order to have it. So that's always our backstop. That's something that we'll have in place, right? Okay.
So and great point. Let me remind the board. This is Director Bogner and I worked on this a lot last year in the middle of the pandemic. We asked and the board authorized us to increase our ability, our line of credit exposure by $200 million last year. We had 250, and the board authorized us to increase an additional 200 million. back about a year ago, we only exercised $75 million of that line of credit authorization because that's all we needed. It was expensive. We were in the middle of a cash liquidity issue with the pandemic. We exercised that. That line of credit matures on April 1. We have requests for proposals today out on the street to banks to bid in for different amounts for that line of credit. We have that at 100, 150, and $200 million. So depending on the responses we get, we will take advantage of different lines of credit. We will dedicate some of those lines of credit, new lines of credit, to back the additional commercial paper program.
Mm-hmm.
So the timing is working really well here with a line of credit maturity and the RFP.
Yeah, that does work out nice. I think my last question, and I'm not suggesting this by any stretch, but I want to understand scenarios. What if we say no? What are the alternatives? What are the different pathways you have to solve the problem if we cap it at 250?
Yeah, that's a great question. So if we say if the board says no, we have liquidity tools. We have $75 million of a line of credit today, right? We could borrow from that line of credit. I'm not going to reveal the rates because that's sensitive, and we have a vendor that's on that side. But just to give you an idea, what we would pay on that line of credit, it's about 10 times more than we would pay on the commercial paper program.
Mm.
So the expense differential is significant. We have the line of credit. We can draw from the line of credit. We can liquidate securities, no problem with that. But again, none of those are financially attractive to the team. That's why the commercial paper program is a way for us to access that capital in a more efficient way.
Thank you.
You're welcome.
Dr. Molhoff has a question in the chat. You wanna ask it out loud?
Oh, sure. Yeah, I was just wondering if we would use that entire 350 million, does that change our debt service coverage ratio that we've set out in our SD?
It doesn't change it, Director Molhoff, necessarily. In fact, I would say it could improve it because we are not adding more debt than we had already planned to add. You know, adding the 350 million, adding another $100 million to the commercial paper program means that we would likely issue the same amount less in long-term debt, right? So it's not necessarily adding to the pie; it's making the pie more efficient in terms of which debt instrument we use. The debt service coverage ratio, though, includes principal payments and interest payments, right? So these potentially would mean lower interest payments, which would help from a coverage perspective. But I say that with caution. Again, there are a lot of really positive things about a commercial paper program and variable rate debt, but there are some negatives too, right? And adding too much of it could put the district at in a disadvantageous position. I think that the risk mitigation that we have today is fantastic, but at some point we may reach that cap on how much variable rate we have appetite for.
I very much appreciate you laying out those risks, and as you described the request, maybe you want to talk about the next slide on our standing overall, and given all of the monitors that we have on our financial position.
Yes. Thank you, Director Yoder. So the next slide, please, Mo. So we have a AA2 and a AA stable ratings for Moody's and S&P. Those are long-term ratings. Moody's and Standard & Poor's also have a short-term commercial paper ratings, and these are the highest ratings, P1 and A1 plus. From both rating agencies. Again, they consistently review our program, our metrics, our risk mitigations. They validate what I just told you. It's fiscally prudent. There are risks, but we are mitigating them well. And again, as I said, we will continue to have that line of credit to match whatever the increase to the commercial paper program would be. The last slide. is we are recommending the commercial paper program to be increased to 350 million total. So an additional $100 million of authorization that again, it provides us that financial flexibility. It's an alternative source of capital at attractive interest rates and supports our credit rating. Upon the board authorization, if the board approves these, I am not expecting us to immediately increase it, but it does gives us that ability, and we will make those changes. I would continuously report these back to Director Yoder and the Finance Committee when and if we end up exercising this authority, and just to give you an update on this piece. And that ends my lengthy Finance Committee report. Happy to answer any questions.
And an excellent report that it is. Yes, any questions? I really want to thank you for laying out not just the opportunity, but the risks associated with it, and reinforcing that we have several tools, both internal and external, to help us pay attention to what's going on here. Any other questions, comments? I don't see any. We are then complete.
All right. Thank you very much. We are going to go ahead and break for lunch now. Let's see, we are just about, 5 minutes ahead of schedule. So we can reconvene here at the scheduled time of 12:40 and have a couple minutes extra to enjoy our lunches. Thank you. All right, and it's 12:40, time to get started again. I only see 3 video cameras right now. There we go. Okay. Let's see, Eric. Next up is Director Williams with the systems report.
Great, thanks very much. The Systems Committee was scheduled to meet on Wednesday, March 3rd, and the meeting was moved to Wednesday, March 10th due to work being done by staff in response to the polar vortex and the hearing at the legislature. To start, the Systems Committee discussed how including climate change language in SD7 environmental stewardship could be pursued. Significant work is already in progress toward the goal of net zero carbon by 2050, including the investment in utility scale solar under the Power with Purpose program, the reduction of carbon emissions from the retiring of coal at the North Omaha facility. In addition to these ongoing efforts to reduce carbon emissions, language to help set a common understanding of climate change in our policy will help us to continue to be a leader in the clean energy transition. The Systems Committee asked management and legal counsel to pursue some language for consideration by the committee, and that would be the potential for a draft revision to SD7 that would be reviewed by the Systems Committee and then presented during the all-committee meeting in April. So those are the expected next steps. And if anybody has any thoughts or input, I'd be glad to hear that now, or we expect a discussion at the meeting next month. I don't see any comments or hear anyone saying anything, but I look forward to the discussion about how we can incorporate that updated language on climate change during the meetings next month. From the agenda, 1 second, please. The next item will be presented by Mary Fisher. So Mary, if you want to take over and go ahead and give us an update on the BRIGHT project.
Thank you, Director Williams. I appreciate that. This BRIGHT battery project we've talked about over the course of about the last year. And I've actually asked Courtney Kennedy to come and present this. Courtney's been leading this effort as our alternative energy manager. And I think it'd be appropriate for her to be able to speak with the board directly today. So Courtney, if you wouldn't mind walking us through your slides here quickly.
Yes, hopefully folks can hear me. Okay, great. Yes, thanks for having me here today. Excited to talk about the BRIGHT project and where we're at. So BRIGHT, for those that don't know, stands for Battery Research Innovation Guided by High Potential Technologies, but we like to call it BRIGHT since that's a few words put together. And this is a project that's being funded through the Nebraska Environmental Trust Air Quality category. OPPD received funding earlier in 2020. This is a pilot project for OPPD really to get our hands involved with this technology. This is the first battery we will have for utility scale, so it'll provide operational learning. When we submitted the grant application, we left it fairly open in terms of technology, knowing that this is evolving, but we do know the size will be around approximately at 1 megawatt with up to 4 hours of duration, and it will be located in Cass County. Next slide, please. So a high-level picture of the project and some of the milestones. You can see we've checked off the list. We got the grant awarded, and since that time, we spent really several months learning about the technology. It's evolving fast, so we started with a request for information or an RFI, and we've done vendor workshops since then. I'll talk a little bit about those on the next slide, and then we have some other milestones that you can see with really anticipated operation early in 2022. So we can go to the next slide, Mo. So wanted to take a couple of moments just to talk about some of the learning that the team has been doing. As I mentioned, we've done an RFI back in the summer of 2020, and then we brought in 8 different vendors for workshops for a variety of team members across OPPD to understand the technology and a lot of the different parts of it that we need to consider for this project. And so you can see this slide really captures some of the learnings at a very high level. But I think one of the biggest takeaways for the team is just how many of these things vary depending on how you use the battery. the batteries can do a lot of different things. I think we hear about that, but really for a successful project, we need to lay out what those are. And many of these, the costs and the schedule and some of those things will change according to that use or to those use cases. Another key item is safety, and we've heard some different events early in the industry with some of the fires, and so we really want to make sure we understand the safety parameters for not only OPPD employees, but wherever the communities that the batteries are. And so there's been a lot of great strides in the industry, and we continue to track those and make sure we're keeping up to speed. So we can go to the next slide, Mo. So a couple more project updates. As we look back on February and some of March, we did bring on an owner's engineer for this project, Fractal Energy Storage Consultants. They're out of Austin, Texas, and really focused in on battery projects. And so when we were evaluating, we thought this would be a good fit. They do projects from very small pilots all the way up to large-scale projects across the country. And so we're really happy to have them on board to be able to learn alongside and have them help us through this project. We've also begun the RFP development. So this takes some time and has some considerations both technically and commercially. So we've been working on that through February and March. And then we're at the point where we're seeking approval to negotiate and award a contract. This would be an engineering, procure and construct, or an EPC contract for the battery asset. And I think the last slide, Mo. So the last piece is really just wanted to make sure that the board and the community are aware that we do have a Community Connect page out there. There's a lot of stakeholder outreach going on at OPPD, and so this is a great way to get involved and share ideas on this pilot. We're excited through the Nebraska Environmental Trust to be able to share the learning, and so we want to make sure people are aware that this page is out there and are able to engage with it. So with that, I'll take any questions. That's all I have for slides today.
Looks like Mary Spurgeon has a question. Mary, do you want to go ahead?
Thank you. Yes. I was struck by the emphasis that how the construction is done depends on what the battery's case use is. Can you describe what possible scenarios you're thinking about as you consider that?
Yeah, so I can share, batteries have a lot of different use cases, like you said. Some of them are paired with generation, some are paired or can help the transmission or the distribution system. And so the team is really looking at kind of the best application for this battery. So there's many different things we can do in terms of helping with peak load reduction, with voltage support or reliability services, and a variety of different things. But we can't always do all of those at the same time. And so some of this is a discussion on what's the best for where this battery will be on the system, and what are the best use cases for us to really learn so that someday when OPPD may scale into larger projects, we'll have that operational learning. So hopefully that answers your question.
Thank you.
Courtney, in the key takeaways slide, you mentioned the technology included lithium ion and flow batteries. Is the action or the discussion that we're having today, is there a particular technology that has already been selected, or is that going to be determined through the negotiation process?
Yeah, thank you for that question. So as part of our grant process, we left the technology open-ended, knowing that this is evolving quickly and there's different options. So it has not been decided between the lithium ion or the flow, and we would like to keep that open as part of that process.
So to be clear with the board, we are asking to be able to bypass the sealed bid process, and because of the complexity of this project, the different use cases that we'd like to understand as we go through this RFP process, we are requesting to use the engineer certification process for the RFP and be allowed to negotiate and award a contract. That requires 2/3 vote of the board for their approval to bypass that process. So want to be clear with the board that that is the intent here, and that is what we'll be asking for your approval upon on Thursday.
And then, Mary, we would report back after all of that is done, I assume. So.
Yeah. I mean, we intend to ensure that the board is and the public is kept up to is kept up to speed on the process going forward, and there's lots of reasons for that. But in particular, it's part of the trust and part of the grant process as well, is to be able to share this information. And so, yes, we'll make sure that everybody stays up to speed with how we intend to move forward.
Yeah, thanks.
And we've talked about location. Is that also something that would be part of the negotiation process, is to determine the final location of the installation?
So the location will be in Cass County, and part of that was in the grant application. And the way that the NET allocates money, we do need to keep that in Cass County. The team is kind of working through a couple different options for a substation that makes sense along with the use cases.
Great. Well, I don't see any other hands up, but this is the same process that we have discussed recently for some of the other power with purpose procurements necessary. So, sorry, I do have a question from Amanda. Amanda, do you want to go ahead?
Yes. What with the grant from NET, do we have any commitment then to share information back with them, or is that supposed to be a two-way street? Help me understand what that looks like.
Yeah, so as part of the grant, we do provide quarterly updates. Our grant coordinator has been doing that, really keeping them up to speed on the process and the learning that we're going through. And then once we do get the facility operational, we'll be able to share that information with other utilities and back to NET. And that is one of the key pieces of the grant, is that we're able to share that learning so that others can benefit from it.
Thank you.
Okay, I don't see anyone else now. Regarding the process, this is the same process that we've used in a couple other times recently. So I think we are generally familiar with it. Unless anyone else has any questions about the process or what we're being asked to approve and authorize moving forward now. But I don't know. I think we'll discuss later, as we mentioned on a previous item, we'll discuss later whether this is a consent agenda item or if this is a specific individual discussion item. So unless there are any other questions, sounds like we are agreed that this can move to the agenda and be pushed forward for a vote, with the reminder that this requires a different level of approval than some of the items. This needs 6 votes, correct? Yeah, so
that is
I guess,
correct.
Yeah, 6 votes is correct.
I didn't hear anyone who sounded like they were not supportive, so hopefully we'll be okay with that on Thursday. Great. The next item, I think, Mary, that's still you. This is a reporting item on nuclear.
It certainly is. I would just like to update the board on where we stand with the nuclear project. As you can see here in the data sheet, we continue to have our critical path be reactor vessel internal components. That includes both the on-site and the off-site portions of this project. Off-site is primarily focused on designing and manufacturing the specialty tools that we need to be able to operate during the segmentation of the reactor vessel internals. On-site, we are making sure that we are moving items that are out of the way, or we're modifying the structures to support this project moving forward. So both are on critical path. And I will say that we're being challenged with that critical path. We continue to work to try to put recovery plans in place to minimize the overall impact of the project, and we'll continue to work on that as we move forward. We do have a subcontractor that has now joined us on site and is performing demolition of the support structures on site. These are clean support structures, and the expected demolition activities will start right around the end of March, so in a few weeks. The scope of the work will continue through mid-2022, so you'll be hearing about this into the future as well. We are installing a rail spur. I think we've talked about that before. It is to be able to move our radioactive materials from the site at Fort Calhoun, process it through a facility that we built on site, put it into the rail cars, and then ship it off to Clive, Utah, where it'll be disposed of appropriately. That foundation has not only been poured, but I was informed yesterday that the erection of the facility and the tent is actually up as of yesterday. So great progress is being made on that project as well. And then last but not least, I wanted to mention that the Decommissioning Oversight Committee came in earlier this month, the first week of March, and really provided that oversight that we're looking for. They always bring us items to work on, potential problems that are headed our way and how to head those off so that we don't have the same problems that they've had historically. And our subject matter experts that come in are really valuable to us in this overall process. So it was great to have them in and to give us that overall review that we look for on a 3 times a year basis. They also had several positive comments about how the project continues to perform and how the team is performing overall. And at this point, if any one of the 3 board of directors that attended that meeting have any comments, certainly entertain those as well.
So I was able to attend the DOC exit meeting, and I mentioned then that it's an unusual engagement I have with Fort Calhoun, having joined the board after it has moved into decommissioning, and then experiencing the flood response, and then the pandemic response. And so all kinds of challenges throughout my experience with Fort Calhoun, including virtual DOC exit meetings. But the consistency with which the stakeholder, the DOC provides input about the success of the project is encouraging and reinforces the great work that we have been doing and that our contracted team have been doing. So kudos to everybody who's been involved. I know that the other 2 members of the systems committee who were able to attend the meeting, this is their first engagement with Fort Calhoun, as they are new board members, and theirs is entirely virtual. So I don't know if they have anything they would like to share, but this is very similar format to the virtual discussion we had just a couple weeks ago. But Mary, thanks very much for all of your great work and everything your team continues to do to keep that project moving forward successfully. And the updates about rail spur and other construction is always great to hear that it's going so well. So thank you.
Thank you.
And I do see a hand from Mary I'm sorry. Mary Spurgeon, if you'd like to share any thoughts about that as well.
Well, I'll just reiterate your comments. Hearing the report and the massive amount of work that has to be done and has to be done so carefully and with great care for safety for all the workers. What I heard was the work groups that are working in an integrated fashion from 2 different entities are just working very, very well. That CFO Fernandez reported that part of the reason we had more expenditures this year is because the work at Fort Calhoun progressed more than they had anticipated that it would. I think speaks to the efficiency and care with which it is being done. I haven't even a smidgen, I think, of understanding of how complicated and challenging the work is. The fact that it will proceed for years gives me a little bit of a glimpse of that. But it was just very heartening to hear that report, and that people feel very, very, very engaged and are overall pretty glad to go to work there because they're working with good people on all sides and with good cheer. So again, compliments to everyone concerned for that. Thank you.
And Director Williams, that concludes my report. Thank you.
Great, thanks very much, Mary. And I think that concludes everything we have for the Systems Committee this month. So next up, I think, is public information.
Thank you, Director Williams. We will move right along here. Director Mulhoff.
Good afternoon. I see Lisa just joined us. So just popped up on video. So the PI committee met on March 9th. Ms. Comstock outlined efforts to continue to lessen the energy burden for customers. The amounts on past due accounts has remained relatively steady, and her report will be posted on OPPD.com and in Diligent for the board members. She did note that with moderating weather, shutoffs have resumed, along with continued focus on offering assistance where available. And on a side note, Heat the Streets successfully raised $103,000 for energy assistance across OPPD and MUD service territory. And I did receive my medal in the mail today. So thanks to everyone who participated, all the OPPD staff who make this event successful, especially to Britton Gable and all the team who make this happen every year. And it's truly a wonderful event. So thank you for that. The committee discussed our work plan for the coming months, and consensus was that further work on SD 11, which is economic development, and SD 13, which is stakeholder engagement, will not be prioritized at this time and will be reconsidered later this year. So there's that. And then the other thing on our agenda was Ms. Olson presented a legislative update, which she'll be discussing on this agenda and her team, and we look forward to hearing from them.
Great. Thank you, Director Mulhoff. And if there's any questions along the way, please don't hesitate to ask or raise your hand. I also want to take a moment on behalf of senior management and the entire organization and the community. Thank you, Director Mulhoff and your husband, for chairing this virtual event this year for Heat the Streets. We did raise over $100,000, so thank you for that, and congratulations on your medal. You're always a great runner in that event as well. We also talked about how some of us are going to use this event to kind of motivate our family members to keep out walking and running and so forth during this time. So we're going to continue to figure out how we can keep the momentum going. So thank you for that. And I also want to thank Director Howard and her mother, who is a director and chair at MUD, for chairing it last year. So just be careful. It's going to be on one of our other board members coming up for next year. So thank you for that. Let's get started and talk about day 44 of the legislative session. It's a 90-day session, so tomorrow will be our halfway point. And Senator Howard, Director Howard, knows exactly what I'm talking about here, that they started full day debate yesterday. So let the games begin on the floor of the legislature. I also we'll be talking briefly about on March 3rd, we spent time down in Lincoln in front of the Natural Resources Committee on the legislative hearing on the polar vortex. So thank you to Tim Burke and LES's and MPPD's CEOs to be part of that hearing. It was an all-afternoon event and went into the early evenings as well. So thank you for that. And there was a lot of people in the organization that put a lot of time and effort into that. So I want to thank them publicly as well. So with that, I'm going to pass it over to Mr. Tim O'Brien to talk through high level of where we're at during this halfway point. So Tim?
Thank you, Lisa. Good afternoon, everyone. It's a pleasure to provide an update to you on the legislative front. I do want to thank many subject matter experts across the district and my team for helping through the process. It has been a very busy 45 or almost 45 days, as Lisa mentioned. The calendar here is important. I like analogies, and so I think about NCAA basketball at this time. This is where we start to see what bills are starting to move. And so each bill or each senator has the ability to create a priority designation that allows them to be moved up in the queue to be heard by the legislative body. So each senator has one of those. Each one of the committees can designate 2 bills as a priority. There's 14 standing committees, and then there's some special circumstances to have some other committees. So You have 49 senators plus roughly 30 bills from committees, and then the Speaker of the Legislature also has the ability to prioritize 25 bills. So you can start to do the math. There's about 700 bills introduced this session, and so the Speaker will announce his 25 tomorrow morning, he stated this morning. So we'll learn what 25 bills will be part of that. So you'll hear in my remarks what's changed since the PI committee meeting and then from our last report. So I just wanted to lay the groundwork of what things will start to move, and so we will keep you apprised of those items and as we move to full debate of the legislative process. So there's a little bit of where we're at. There are a handful of slides that list the bills that we've been focused on. I will hit the high points of what's changed, what's different, and some of the discussion coming out of the Public Information Committee. So if you see something that I don't hit, just pause me as we're moving to the next one. There's a couple bills that I'll speak to you on this first slide. LB 83, we've talked a few times on this one. This is around clarifying how boards can meet from virtual sense. This bill was actually debated on the legislative floor, and I think I didn't check the vote, but I think it was nearly unanimous approval to move to the next round. So that was a good sign. It does make some improvements. It doesn't make some of the things I think we were hoping for with some more flexibility to use virtual settings, but I think it's a good step in the right direction. So it has moved to the second step of the debate process. The next bill I'll talk about is, it'll kind of transition to the next slide if Mo would want to go to that, but LB 126, there's a couple bills on this next slide that have to do with safety. So using phones, turning lights on while you're driving, et cetera. Those bills did not move out of the Transportation Committee that they were in, so they're indefinitely postponed. So we don't see those bills moving forward. One thing I forgot to mention is that we look at this as a 2-year process. So these bills, if they don't move this year, they can still be in the queue for next year, along with new bills that'll get added. So some of the work you'll hear me talk about, specifically broadband, will probably be a 2-year venture with us. And so just wanted to share that perspective as well. So on this slide, let's see. The safety related bills were important. Another bill, LB 266, around the Renewable Energy Standards Act. There's been no change since the hearing on that particular bill. We're hearing potentially there could be a legislative resolution to study this more in the interim of the legislature, or perhaps it could connect to a follow-on legislative resolution from LR 48 that Lisa spoke about when we presented about the polar vortex. So that could be tied into that particular process. Mo, if you want to go to the next one.
Jim, Eric, did you have a question?
No, actually about 266, I appreciate the clarification about next steps there, Tim. And I'm curious if there's any connection between state and federal legislation. I know we generally talk about them separately, but this one I know we've talked about a couple times in the past. I personally support a clean energy standard both in the state of Nebraska and at the federal level. And so I'm very glad that we are involved in this. I hope that we can be supportive of something like that moving forward, and that we can find some overlapping interest between what's going on here with 266 and what we might be talking about at the federal level, maybe over the coming months, because I don't think anything has been presented there. But is there any overlap between the two right now?
Thanks, Director Williams. I think in concept there's a lot of discussions around that. I'll jump to the federal side after these slides, but I think we're anxiously waiting to see what federal bills come through. There's a couple that give us some flavor, but more will be coming, and so I think we'll start to see what relates from the federal standpoint, and then going into next year, 266 will still be there, or potentially if it moves to a legislative resolution, it'll be studied, and then potentially new ideas could occur in the next legislative session. So we are definitely keeping a keen eye on that particular topic and how they line up from a state and federal level. So I appreciate the comments. Let's see, where are we at? Mo, if you want to go to slide 90, would be the next slide. I'm really excited about this particular second bill. Oh, if you want to go one back, 306. So this has been a bill led by OPPD with support of the Power Association. just an immense amount of work on this particular bill. We're really thrilled that there's so many co-sponsors on the bill. It has been prioritized by Senator Brandt. We've been working really hard to continue to educate on the topic. There was some questions on how the fiscal note works out, so the cost associated with the bill. We've been doing a lot of work there, and even the last few days doing some case studies and other things, so the senators will be able to have that information as the bill will hopefully move to floor debate. We think as soon as the next week or two, potentially. So great progress there, continuing to work hard on that particular bill. So that's some really wonderful news that we're able to have that happen. Another bill on 344, this is around one call. You might recall we've talked about one call, I think, the last couple legislative sessions. This one had an amendment. It didn't fully address our concerns, really creating another step in the one call process. There has been no priority to this. There's a potential the speaker could add it, but at this time it's still holding there. Mo, if you want to go to the next slide, there's really no significant movements on the other bills here. First on this is LB 409. Around our last update, we did oppose this bill. This is Senator Brewer's a bill around transmission lines and a moratorium on those and a variety of steps around that process. The senator did prioritize this bill, so we expect it to move to floor debate sometime here in the near future. We will continue our role of opposition there. LB 449, this is around adding more funds from the general funds to the Department of Energy and Environment for their weatherization program. This bill hasn't had a priority designation. However, we've been working hard to add this money potentially in the budget. So the governor and other budget bills will be coming out. And so hopefully it can just be in the budget bill, and we've had success there. The governor's budget bill will be 380, LB 380. So we will be watching that as those things happen. So we feel pretty optimistic that we've made some success there to add some more funds to that program, which I think is just wonderful. So watch for that one. Also on this slide, LB 460, this is a bill led by our team. Javier testified at the hearing on the 9th of February. This bill got a lot of discussion, a lot of interest, and brought what we had hoped, the topic of broadband utilization and where our infrastructure could support that, where we're not competing with telecoms, we're just offering our assets to support the endeavors of more broadband. Unfortunately, it didn't make it out of committee, so we're looking at this as a 2-year bill, so we'll keep talking and hoping that it can move forward next year, but really was a lot of hard work and really brought great discussion. Let's see, 474, next slide, Mo, please. 483, this is on the climate action study, or study and then plan. There has been no movement on this particular bill. There were the senator that introduced it was working hard to address some concerns, including funding. It was not prioritized. It still is in the committee, and so it is probably a 2-year bill in that regard. LB 512, this is the Critical Infrastructure Utility Protection Act. Javier also testified for us on this bill on the 1st of March. That brought a good discussion and brought to light the importance of our work. And so that discussion was extremely helpful. The bill was not prioritized, at least as of yet. Potential chance the speaker could prioritize it, but we'll find out tomorrow morning. It still is in the committee sense, so we'll keep working on that particular bill, even if it goes into next year. You'll see a few slides on broadband. I'll talk a little bit about that on the next slide. Mo, if you'd go to slide 93.
Tim, I think Amanda has a question.
Yeah, before you move
Absolutely.
on, can you help me understand a little bit more about that Critical Infrastructure Utility Worker Protection Act and how I would assume that it coordinates or correlates with our safety program in some way? Is that, and how would that change what we do?
You bet. Thanks, Director Bogner. I may phone a friend if Javier wants to jump in, or Seth too. There's a few parts to this. One is just the acknowledgement of the critical nature of our work. And so some of the things that is unclear on how things are operated, like the ability to get certain equipment. So when we started the pandemic, could we get masks or hand sanitizer or some of those things? Or where might our employees fit? It's in the unique sense of the vaccination process. And so where are we in terms of those designations, and who designates what critical workers or not? It's a little bit unclear. The governor has a lot of power to do that, but we're trying to just clarify the importance of our work and where we would fit in some of those different aspects, even as so much of just how we operate. I see Javier turned his camera on. I'll let him give a little update. He had some good questions from the committee during his testimony. Javier, I'll turn it over.
Yeah, Tim, without repeating what you said, very important bill for us. I think it would provide a lot of clarity when the times are tough, just who gets priority to do what. You know, the governor has been very supportive of the work that we've been doing, but it's required so far a specific call to action, right? And these would be codified in law. There were several questions from senators during the hearing about some of the questions were, can you tell me about one emergency situation where not having utility workers would make it better, right? And no one could come up with that. So I think there's overall consensus that electric utilities are incredibly important. I think the discussion, the debate was, are all utilities included? Because this bill as presented included electric, water, sewer, telecommunications, and it was a little broader. And I would say that probably the biggest concern I heard was that of funding. There needs to be clarification about, are we asking for more funds? Are we asking just for prioritization for PPE and vaccines, et cetera? OPPD, we've paid for all of those things ourselves. Our customer owners have paid for that. But there's some clarification that's needed regarding funding and regarding whether all utilities would be considered in here. I think that's where the refinements will happen here in the next day, or if it moves to next year, that's probably where the conversation will go. But there was no question about the importance of electric utility workers.
Thank you very much.
Eric, did you have another question?
Yeah, on LB 506, a number of bills related to net metering have been introduced. Can you remind us of the content of this one, what the intention of this bill is?
Absolutely. Thanks, Director Williams. I appreciate that. So LB 506, this particular, there were several bills. There's one that I believe Senator Bostar had that has the percentage of how much net metering can be offered from 1% to 3%. This particular bill clarifies the AC or DC output, and so it sets a standard on 25 kilowatt hours, because right now it's unclear. Electric utilities can do it differently, and we found that across the state during the hearing, that some utilities use AC, some use DC, and so that's what this particular bill is clarifying. There is another one by Senator Wayne that is a broad opening of or interpretation of net metering outside of different generation types. That has a lot of other caveats and details. So all three of those bills have not received a priority designation, at least from senators or committees. There's a chance that the speaker could provide them. And so we're watching keenly to see what the speaker has for priorities tomorrow, but my sense is there is a slim chance that any of these bills will move forward, at least in this current session. Next year, they certainly may, and I think that's the topic that we will have continued on our legislative work plan to get more clear on the various issues and opportunities around net metering. So I thought I'd wrap all those updates together, Director Williams, based on your question on net metering.
Yeah, and regarding specifically the AC and DC component, the legislature can require us to change our policy, but I think our policy as written also has both AC and DC included. We could voluntarily decide that we would like to clarify that to provide more certainty to installers or customers who would like net metering independently in our own rate structure, couldn't we?
Yeah, I think that
that conversation is going
on, I believe, right now. I don't know if Julie had a family item today, but that conversation is going on between Javier and Julie relative to the rates and the ACDC limit and how that impacts. We do have the capability to change that. What we were seeing is that if it got a priority in the legislature, it would drive that answer. And so if we don't believe there's going to be a priority that's going to show up, we'll have the ability to address that. So I know that conversation is going on between at least a couple committees would be my guess. So
Great. Yep, I'm glad we're working on it, even if it doesn't move forward with the legislature. Thanks very much.
Excellent. Appreciate the questions. Just a couple slides left here. Mo, if you want to go to the next one here. This is really kind of the wrap up. I did talk a little bit about broadband. There's several bills that may relate to that. The governor has a interest in allocating $20 million of grant funds for broadband deployment, and also to set the standard for 100 megabytes down and 100 megabytes up. So we're keenly watching that. That bill is 388. We expect other thoughts and ideas could be attached to that. So we're still keeping a keen focus on broadband on that topic. So this is the last state update slide. We talked about net metering. There's a couple on here already. 619, I'll highlight this. This is just an example of us working closely with the senator. This bill is another one call related bill, and it sought to set standards on trenching and cable bearing and other things like that. We talked with the senator, and they worked to create an amendment that would take electric utilities out. So it was a good focus there. However, the bill hasn't had a priority status. It could from the speaker again, and so we're keenly watching that bill now and then into next year. And then let's see, the last one Lisa talked about, which was the legislative hearing that took place on the 3rd, and we're continuing to do some follow-up there, but overall that went really well. The last one that's not on here, just an action that we watch pretty closely, is the budget. So this is the 2-year biennium budget that occurs. The main sort of budget bill is LB 380. So we're watching what will happen as the budgeting process happens with the legislature. So that concludes the state report. I have one slide on the federal update. Mo, if you would skip to that, please. So just an update of what's happened since last time we talked. There's a lot of bills introduced. Even from Tuesday, there's more bills introduced from above. And then one of the things that we're excited about is the next stimulus package was approved and signed. And so we're waiting through that. Now there is a lot of things in that particular bill. Some highlights are there is, let's see, I think about 20 million in, no, that's incorrect, 4.5 billion in LIHEAP, about 20 billion or so in renter assistance and other things in that regard. So that's been very helpful. There's some homeowner assistance funding. That's almost 9.5 billion. Then there's some other pieces and parts for nonprofits and other things that we're watching to see if there's opportunities, just as we did with the CARES Act. So we're diving in far there. The other thing that's interesting in this particular stimulus package is there's, I think the number's around 350 billion that goes to state and local entities to recover some of the impacts that they had. And so we're watching and trying to understand how that piece will work. So huge bill, lots of details, but I can tell you we're working very hard to watch it closely. And if there's an opportunity to help our customers, we will definitely do that, just as we did with the CARES Act. A couple other things, there's been two bills that have been out a little bit, the Green Act, the Clean Future Act, but then just last week, we're starting to see where transportation and infrastructure will show up. This will be something we're hearing that Congress will take up perhaps in the summer or fall, and that would be the LIFT Act that's kind of down a few tacks. So this is part of the transportation and infrastructure package. It's a big bill. It's about 500 pages and 300 and some million from the House side. There's a lot of stuff packed in it, from EV infrastructure to there's some things in broadband. There's several areas for grant opportunities. There's some 911 work. There's some cybersecurity and others. So it's something that we are taking a keen interest and focus on through our work in Washington, D.C., and then through our partners through APPA, LPPC, and others. So excited to see some of the energy related topics starting to move. And so we'll spend more time as the legislature starts to wind down. We expect more federal updates to come your way. So we will keep you updated. With that, that concludes my planned remarks for today. Thank you for the time.
And that concludes our wrap up, Director Molhoff. So back to you.
Okay, thank you. And I just want to give a big shout out to our folks on the legislative side. It's been a crazy time for them and a lot of juggling to do. Also, to everyone in the OPPD organization that had anything to do with Tim Burke's presentation and his testimony at the LR 48 hearing. Excellent, excellent work from all the printed materials that you provided to the committee and to the board, as well as your work behind the scenes to make sure that he had the best and most accurate information. So thank you for that. Are there any other questions from board members or from the committee members or comments that they want to go? If not, we can move to the next agenda item, which is, I think, other business.
All right, I do not see any additional hands up, so we will move on. So the next item on our agenda here is to review the agenda for our meeting on Thursday. Right now, the 4 action items are listed as consent items. Would anyone like to move any of these items into the discussion section of the board meeting? Just a reminder that when there are items on consent, we take public comment, but we as the board do not have time to discuss each item individually. So if there's any discussion that needs to occur, the item needs to be moved into the discussion action item list. I did get confirmation from Steve Bruckner that even though we need a 6-8 vote, or at least 6 votes on the engineer's certificate, it is still able to be in the consent action item. So just
Well,
looking at the screen. Go ahead.
Director Yoder had mentioned pulling SD 14 off.
Yeah, I mean, I did mention it, and thanks for the reminder, Director Bogner, that the public will be able to comment on this even if the board is not talking about it. So my intent on that was just to be clear that that employees or whoever, whatever member of the public could speak about that. So that was my intent. Now go ahead, Director Moody.
Nope, I just want to make sure that we didn't miss that. So it sounds to me like you're comfortable keeping it on consent then, is that right?
Yeah, that is correct.
Okay, that's fine with me. Great.
Okay, unless there's other comments, anyone else want to weigh in? Okay, I see head shaking no, so I think we are good with the agenda as it's written. Okay, now the next item here is board work plan. So I think I'm supposed to lead this discussion. Okay. All right. Okay, so go ahead, Scott. Can you place my phone a friend and have kick it to you?
Sure. As we continue to build this muscle on the work plan, the preceding slide is just a reminder of the process, and so I don't know that we need to go through that. But really, it ultimately creates a queue of dynamic environments or items that could be added to a list candidly at any point in time. If we could move to the next slide, Ms. Henners. So this is currently what the work plan shows. There are 4 items that are in
progress. I don't think anything new was added in this month's work plan, and this just provides a brief process update with regards to the initiatives. There was status update on these particular items, however, that may warrant some conversation.
Yeah, and I think that Director Molhoff had already identified that a couple of the SDs that are going to be worked on this year have the priority of that has been pushed to later in the year. I remember hearing that earlier today. Is there any further conversation that needs to happen around those things?
Yeah, I'm curious as to what takes their place.
I believe that's CEO succession. Director Yoder, do you have any follow-up question?
Well, I think we're all doing that, aren't we?
That's fair. Would someone from the PI, Janice, would you like to maybe address that from the PI?
Sure, I can address that. So the proposal about the SD11 and SD13 that had come to the committee previously was almost a total rewrite of the entire of both SDs. And the committee felt like that this was too much to take on all of this, and that at this point, the SDs more appropriately should be tweaked and not totally rewritten. And so that was the perspective of the committee, and I was respectful of that sentiment from the majority of the committee members. So that was where we ended up, that we would relook at it end of the second quarter, end of the third quarter. That gives us some time to think about how we want to proceed and make sure that we're using good governance principles as we're moving forward and not trying to make too many changes all at once in the midst of the new CEO and everything else that's going on. So that was I guess if any of the other committee members want to weigh in, that was my my take on the agreement, the consensus of the committee.
Well, I don't. So I'm not going to argue with the conversation of the committee. I think I want to focus on this muscle building that we're working on here, and how things are flowing and how we have conversations about that. SD11 was identified in August of 2019, I believe, as something a couple of the board members wanted to put in the parking lot. SD13 throughout 2019, and certainly by November of 2019 was seen by, I believe, all the members of the board as something requiring work. And so here we are in the first quarter of 2021, and so I'll take ownership of not having more done before then, but to then kick it down the road a little bit further is, I think it's reflective of my ability, because I was PI chair last year and the committee there. I'm just reluctant to continue to say that things need to happen here without some kind of date of when something's going to happen.
Yeah, I hear that. The kicking it down the road is, maybe a quarter down the road, not years down the road. And certainly a couple of members of the board putting something in a parking lot doesn't imply unity of control. It doesn't imply that all the board members are necessarily aligned with that. So again, the committee decided as a group to go with this timeline and take a more moderate approach to the revision of SD13 and SD11.
I think when the committee has more to report, we'll bring it to the board. Is that
I
fair to
didn't
say?
hear that, Mike. I'm sorry.
So when the committee has more to report, we'll bring it to the board. Is that fair to say, Janice?
I didn't hear what you said, Mike. Sorry.
I was saying when the committee has more to report, we will bring it to the entire board. Is that correct? That's about it.
Yep, that's correct. So we're not changing the status of that from being a work in progress to a total pause. We're just saying it's not going to happen between now and, let's say, June. It's going to be more third quarter activity. And I think that that is fine. Dr. Williams, do you have something to add here?
Yeah, I mean, we mentioned the idea of unity of control, and I agree that we want to make sure that we are all on the same page about updates as they move forward. But you know, as we talk about this board work plan, is there a way for people who are not on the committee to express their opinions about an item if it doesn't ever make it to an all committee agenda? You know, as Rick said, this has been discussed as far back as the last half of 2019. And so I would agree, it now seems difficult to say that I would also prioritize some updates on some of those, but there's no method by which board members who are not on that committee have any input, I guess, unless it makes it to the all committee agenda for discussion. And so, you know, is there, I don't know how we balance what we describe as unity of control if it is just, you know, handled only in a committee that doesn't make it to a discussion of the entire board.
But if I'm not mistaken, this is Tim, and apologize for my engaging in the board work plan. I don't think any of these would say that nobody in the committee can provide perspective, insights, or you know, recommendations. And I think we've seen that over time in each one of these categories that have been identified. So I don't think that is restricting anybody from providing input if they want to provide input. I think the balance that specifically on SD 11 and 13 is, as we begin to think about the activity, either with strategic initiative work, our decarbonization work plan, our stakeholder engagement piece that we have going on, including our Powering the Future piece going on. I know certainly my team said, if we're going to move through a significant review of each one of these SDs, something has, because it's similar folks that would be doing some of that same work, is that we would have to reprioritize some of those other activities. And I don't want to speak for the committee in this, but I think our team felt the review of SD 11 and 13 probably doesn't have the same priority from our perspective anyway, as does the activities that are going on with the decarbonization workshops that start at the end of this month, and the other stakeholder engagements on Powering the Future, and the Southwest SARPI transmission project, and the Power with Purpose stakeholder process. So as we begin to look at all of those pieces, it's pretty concentrated and committed on a number of different things that tie in both of these SD 11 and SD 13 elements. And so that is what at least my team, I think, has talked to the committee about, and how do we balance that, and how do we prioritize that? I don't think it's a deal where we're asking that it just get cut off and take these off the work plan. That's not what we're saying at all. It's just saying, you know, let's move them out to a point where we have time and space to have that discussion. But I don't think any of this limits the board from recommending to the committee, here are my thoughts around, you know, SD 11 or SD 13 or SD 2 or SD 7 or whatever that may look like. So I still think the point of the work plan is people know it's out there, and if they want to engage around it, they certainly can do that and provide their input in that process. So just my thoughts. So sorry about interrupting on the board work plan. I'll now back away. Over.
Thank you, Tim. Director Howard. We can't hear you.
Happening again? Can you hear me?
Yeah, there you go. Yep.
Okay. Sorry, this happened on a staff meeting the other day. I want to be clear because I think I'm the only PI member who stayed on between Director Yoder's tenure into Director Malhoff's tenure. I think if the changes that had been suggested to SD11 and SD13 had been quite small and nuanced, we probably would have been able to put them forward to the full board. Unfortunately, because they were quite a heavier lift than that, the discussion that we had was really around considering the changes of leadership that were going on at OPPD. We wanted to make sure then that a new leader would also have the opportunity to participate in something that appeared to be a wholesale change in some of these strategic directives. And so I certainly hear the Director Yoder's pain point in terms of timing, but I also want to be mindful of the other things that the organization has on its plate. And looking at the fall, my hope is that we would be able to put together sort of an ad hoc group of directors who are invested in these strategic directives outside of the PI committee, so that everybody who has an investment in getting the language right would be able to spend some time making sure that it matches the mission and the aims that we're going for. So that's my 2 cents on sort of the transition between Director Yoder and Director Malhoff in the discussion on SD11 and SD13. Thank you.
Thank you, Director Howard. Director Moody, you had your hand raised and then took it away?
Yeah, I did because Sarah hit it.
Hit it. Okay.
Yep.
Excellent. All right. Same with you, Director Williams. You were going to comment and now you've renamed. Okay.
I wanted to make sure Director Howard could jump in there. I guess regarding timeline, the discussion about the ongoing engagement on a number of topics does seem, I don't know, challenging relative to the SD13 stakeholder outreach and engagement update. I mean, I think the intention in November of 2019 was to have language updated so that when we did additional significant stakeholder outreach, we had clarity on what would be expected and what we would look at in a monitoring report. And so what is described now is that we have a bunch of stakeholder outreach and engagement occurring, and that needs to take precedence over a language update to the monitoring report, which would review the actions of the outreach and engagement. And so, that does seem like a very challenging situation that we find ourselves in. And I mention that only because in the other one that I talked about earlier today, SD7, regarding a climate change language update, we have specific long-range planning activities occurring right now. And I think the intention is to make sure that the strategic directive is updated so that the activities that are ongoing have a clear understanding of what the expectations of the board are, so that we don't end up carrying out activities only later to find out, dang, it looks like we wish we had made an update to that strategic directive before those activities had been carried out. And so I recognize what Director Howard had pointed out about making sure that we spend the time necessary to do the work for the scope of the policy update that's necessary, but it does seem like a challenge because this had been identified specifically after the last time we had a significant stakeholder outreach and engagement opportunity. And now the next time we are doing multiple stakeholder outreach actions, we haven't made the language updates. And so quite frankly, the accountability on what we expect in the monitoring report is a challenging position because the language hasn't been changed compared to the last time an activity was carried out. So I hear where Rick is coming from, and I understand that a lot of things are occurring, but that is a challenge. It is a very difficult situation that we find ourselves in, that we didn't get the updates accomplished before the next time when they would have been relevant to the actions being carried out.
All right, Director Moody, you want to weigh in?
Yeah, now I do have something to say. So two things. One is, if this was so important, we should have got it done last year. We should have got it done last year, and it came from last year's committee to this year's committee, and it wasn't in a position where we were even really in a position to look at it in a meaningful way. So that's, I guess, the first point that I would make. Second, the frequency with which we've talked about the importance of SD13 in hindsight of the Power with Purpose work that happened in November of 19, I'm pretty confident that because we've hit that nail so many times, that the senior management team understands how important it is to us. Sure, there's probably some opportunities for improvement in the SD13 language. No question about it. We can do that. A lot of it is about interpretation of the language too, right? Like what we actually put in the SD and how it's interpreted are two different things. And I feel like the frequency with which we've talked about the importance of public engagement and what we want to see out of that in almost every meeting we've had since then is really hitting home how important and the kind of work that we're going to see with all of these outreach activities that, you know, are underway today for that matter. So I personally don't think that we're in a position where the board sentiment is unclear. I think it's actually extraordinarily clear because we've talked about it so many times. And I'm confident that the senior management team and those that are executing on this have a pretty good sense for what we're looking for.
I was going to share something very similar. Director Mulhoff, I see that your hand's raised, so just give me a second. I think that we've had a lot of great examples over the last year that we can draw from and clarify those expectations, and management has heard those concerns. And I think because they bring it forth for us for any initiative, you know, for example, the CEO succession process, we know the very clear stakeholder, you know, engagement that's going to happen there, because they knew that that would be an important question that we would be asking. And so, you know, that process has been flushed out and is appropriate for that work that we're going to be undertaking. That's just one example. So, you know, Director Moody, I concur with what you stated, that if anything, we are in a more clear position now. And yes, we need to shore up the language, but I don't think that we're at risk of missing out on something this year because we don't have that final SD 13 language that we're happy with. Dr. Mulhoff.
Thank you. So looking back over the last few months even, and the changes that I've seen in messaging, in outreach, in communicating with our customers, to me has been remarkable. And I think that the PI committee in the interim, you know, until we get those changes made to SD 13, will be asking hard questions in our committee of Ms. Olson and Ms. And her team and all of the customer outreach folks, to make sure that we are kept in the loop of what their plans are for the IRP, what their messaging will be for the decarbonization, and all of the messaging around these important initiatives that we're working on right now, that those plans for transparency and customer engagement are brought to the committee, so that, you know, if we see that they're not meeting our expectations, then we can redirect. So that would be my challenge to the committee and to senior management, that we are really engaged in that process.
All right. Thank you for the good discussion. Director Yoder, do you have any final questions, concerns, comments to share?
Sure. Out of Finance Committee, we had a discussion about expectations and what was required by contract. I think now, when the good work by VP Olson and her team, I agree, we've seen a lot of things improve since 2019. But now, when we are all agreed to the higher level of work, would be really a good time to codify that, so that when leadership changes or board members change, that we've got that agreement set down for future people who fill those positions. Now would be a really good time to do that. And so, but, you know, do what you can. I think we've had a good discussion around the board work plan and our expectations of it. As Scott said, you know, we're building this muscle, and much of it is about figuring out how it works, related, especially between committee and the board as a whole. So, good job.
All right. Okay, with that, Director Molhoff, is your hand up still? Because you haven't, okay, thank you. With that, we do have a 90-minute decarbonization presentation that Ms. Fisher will be providing us. I'd like to take a short break prior to that so we can refresh our coffee or our water glasses, get a snack, those types of things. We'll come back at 1:55. Can we just make it a 5-minute break? Should it be a 10-minute? I don't know. What do y'all want? 10. Okay, 10. We'll come back at 2 o'clock. Thank you.
All right, while we're on this break, Mr. Aaron, Arnie, and Zachary with E3, if you wouldn't mind going ahead and checking your microphone and making sure you can hear and turn on your camera and all that good stuff. And we'll go ahead and just make sure you're all good, and then we'll be all set.
Hello, this is Arnie from E3. Can you hear me?
Hi, Arnie. Sound great. Thank you, sir.
Perfect.
And this is Zach from E3.
Zach, thank you very much.
Hey, it's Aaron. Can you hear me?
Yes, Aaron, we can hear you. Great. Thank you, sirs. And thank you for your
Thank you, Brett.
flexibility.
Appreciate it.
Yep.
Brent, can you hear me? It's Jeremy.
Hey, Jeremy, you sound good, man. Thank you. And then I know we have Mr. Fortney, Mr. Edom, Jessica Del Torre, and I think Tim O'Brien is still online as well. I believe we have everyone we need for the decarb session. And Colton, sorry, Colton, I missed you there.
Good afternoon, Emily. How are you?
I'm doing well, Mr. Burke. How are you?
Wonderful. I am doing just fine. And
Congratulations.
Colton, yeah, thank you guys for joining us today.
Hi, Tim.
Hey, hello there. How are you?
I'm doing all right.
Wonderful. Super. Super duper.
Hey, Mo, are you there?
Yes, Mike.
Hey, I was looking through my schedule book now, and I'm trying to. I don't think I wrote down the date we set up for Tim's quarterly meeting. Would you have that available now, or if not, I could check with you tomorrow, I suppose, if you don't have it available.
Mike, I'll look right now.
But that's what Tim, yeah, probably in his schedule too.
Yeah, it's on mine. Let's see. I'll see what I got here, Mike.
I can't remember if it was March or April. I can't.
It might be.
You got to see all the stuff I have crossed out in this book. God. One of these years I'll put it in my phone.
Oh, there you go. There you go. That's all I live with
Yeah,
is
I know.
phone. Mike, it is March 31st.
Okay.
At noon.
Sounds good. Okay.
And if you want to do it WebEx, we can do it WebEx. If you want to meet in my office, we can meet in my office. So whatever
Okay,
works for you.
Okay, let's be in touch base before that. We'll see.
Yeah, sounds good. No problem.
Thanks,
all right.
Tim.
Perfect. Thanks, Mike.
Okay.
So Tim, was that a skiing accident that you hurt your arm?
I wish it was that fun. I was trying to shop at one of our customers in Ceresco, and these two young guys on a Friday night loaded up a coffee table. I was rolling back the top of my pickup soft cover, and they put the coffee table up on its end. And then one of the guys jumped on the truck to put the lamp tables in, and the coffee table started to come down. I was on the running board, and as I reached just to break the fall, I wasn't trying to catch it, but as I was breaking the call, my arm got caught on the lip of the truck, and I just heard two pops and had to repair my tendon. So, but anyway, rehab's going well, and I'm in a little protective thing here, more just to remind me I need to protect it. But rehab's going well, PT's going well. They say I'm doing well.
Yeah, I saw at the LR48 hearing you were in.
I didn't get a whole lot of empathy from that, did I?
No, you didn't milk that one very. You didn't
No,
milk
not at
that
all.
one as much
Not
as
at
you
all.
could have.
I wasn't expecting to anyway, but anyway, no, that was, but it's getting there. So they said it was good surgery. Flexibility is actually pretty much back, so that's good. And I'm just working on strength and some of that stuff. It's amazing how fast the muscles atrophy. I didn't realize. I've never had I had a thumb that was hurt one time. I had to restructure that, but I don't remember the atrophy. But there's not a lot of muscles in that area in the hand. But
you're lucky. You're lucky you didn't happen at work. You'd feel the wrath of Kevin McCormick.
I had to report it. Part of the deal is if you have one of these accidents.
Thanks, Mike, for reminding him about that. Yeah, thanks for reminding him about that.
I had to. I reported it right away. About I was out of position. I didn't have my head in the game. I wasn't thinking, and they all reminded me that I was absolutely correct in that. So.
Well, if you think about getting in the moving business, I would suggest keeping your day job.
Yeah, I think I'm not going to go get in the moving business. So, probably better off not. So, although it'll be stronger than it's ever been. So,
Yeah, okay.
yeah.
We hope. Okay, it's 2 o'clock, so let's move right along here. We have the decarbonization strategic initiative update. I think we're all looking forward to this one. Ms. Fisher, are you available?
I am ready and waiting. We have been wanting to do this for the last couple of months, and so we too are excited to bring this to not only the board of directors but to the community. The team has been working really hard, and what you're going to see today is the progress that we've made through probably about the end of February when we started trying to finalize these slides. And so they may talk about a few things that we've moved a little bit further on. I'd also like to welcome our partners. We have some guests joining us from E3, and they'll introduce themselves when we get to that section of the Pathways to Decarbonization presentation. I will forewarn you that this presentation, although it has 4 different components, it's very interrelated. And if you start asking questions too early, there's probably all of the information that you want towards the end. And so if you can refrain and maybe keep tabs of what those questions are and make sure that we answer them as we go through it, we might get through this in 90 minutes. But it has been a struggle for the team to get through all of this information in 90 minutes, so I'll just be upfront about that. But I do really think that many and most of your questions will be answered by the time we get to the end of the presentation. So with that, I'd like to turn over to Jeremy Bowers. Jeremy?
Thank you, Mary. And with that in mind, I'll try to keep my comments brief before turning it over to the project managers. But it's a pleasure to be here to discuss the progress of this decarbonization work. As you'll see, that this work's ongoing and it continues to move forward, despite the many ways the district and our industry has really been challenged recently. Top of mind, and we should mention this in the context of decarbonization, right, is the recent polar vortex event, which it just highlights and demonstrates the necessity of valuing and optimizing all 3 aspects of our mission, the affordability, the reliability, as well as the environmental sensitivity as we plan for the future. So we're excited to talk to you about this progress, and you'll see as we move into a series of conversations on this. So as we go to the agenda here, you'll see we're going to start our update with our community project. And this highlights the fact that we're thinking about this conversation as an issue that's really going to take all of us. We'll move from that broad community thinking to an update on our customer project and the products and services, the roadmap that's being developed there. We'll then turn our focus specifically, inward to OPPD and report on our first deliverable of the initial greenhouse gas inventory. And then we'll move to, the heart of our business with the energy portfolio project. We're excited, Mary mentioned, we're excited to introduce you to some key partners for us on this and talk to you about how the project's progressing. Finally, we'll conclude by describing and announcing opportunities, and I heard this mentioned earlier, but for our customer owners to join us in the coming weeks as we continue this journey. So you'll notice up in the right-hand corner, you see these icons here of each of the projects. You'll notice up in the right-hand corner as we move throughout the presentation that those will be in each section. So if you have to get up in this 90 minutes and return to us, or otherwise just want some context on where we are in the presentation, you can look for that icon in the upper right-hand corner. So with that, I'm going to turn it over to Emily Muth. She's the project manager for our community project. Emily.
Thank you, Jeremy. Thank you, Mary. Hello, all. Great to be here today. Mo, if you want to advance to the next slide. So pieces of the decarbonization community strategy, our first priority here was to prioritize community scale decarbonization strategies and identify where OPPD can be that community partner, not only on decarbonization, but environmental stewardship. To do that, we started looking out at various strategies and reviewing documents. And as you can see from this word cloud here, there is an enormous amount of work happening out there. So our first goal was to, how do we prioritize this? And how do we pull it together in a cohesive strategy? To do that, we enlisted the help of HDR. So they helped us work on this approach and framework. If you want to move on. Well, so the first step in our approach was really to look differently, look at how the work that we do at OPPD is viewed by our community partners and what our role is in our communities and aggregate those various strategies that communities do to mitigate climate change and in various climate action plans. So we looked at, to the next slide, we looked at 6 different climate action plans from a mix of regionally relevant communities and peer utilities. And so those climate plans include the City of Lincoln, City of Fort Collins, City of Austin, MARC, which is the Kansas City regional area, City of Ann Arbor, Michigan, and the City of Iowa City. What we saw in those plans was everything from a directional approach. So we have goals outlined in these plans, but there was no specifics to plans that had detailed consideration for implementation and co-benefits. I will say out of all of these that we evaluated, there was a total of 928 mitigation strategies that we're trying to whittle down in category into something a little bit more refined. And as it says on the slide, 4 out of these 6 communities have declared a climate emergency as of 2019. Next slide, please, Mel. So the second phase is to take this information that we got and figure out how do we prioritize it? How do we prioritize our voice in the community and identify collaboration opportunities? So to do that, we developed this degree of influence concept. You want to advance to the next slide? That concept looks at where OPPD needs to be involved. Where are we at the core? So what can we initiate? How and where is electricity generated? So various infrastructure programs and policies related to community rooftop solar, demand side energy response, biogas recovery and reuse, or geothermal. And then taking it a step outward, where are we an influencer? How can we influence how electricity is consumed? And we'll hear more about that with Paul and his work in consumer products and services. So when we talk about demand side management or energy efficiency, how are we an influencer in that space? And then finally, the outermost degree of influence would be where should we be involved? How are we involved in electrification of non-electric energy? So heating and cooling systems or transportation. We hear a lot about that first last mile mobility. What is OPPD's role in our community as we examine various places to be involved? I'm going to move to the next slide. So finally, we can take this community view, the framework that we've put together, and apply those strategies to identify key stakeholders, for which we've already put together a list of quite a few stakeholders that we're already involved with, develop plans and protocols for a pilot community, and quantify the value of decarbonization. So our next steps are going to be to get this framework finalized in a report that we can come back to you all with and have that posted externally for viewing, and then potential outreach. So we started with this broad conversation, right, about the impact of community. And now we're going to move on to how OPPD is thinking about our relationships with the individual customer in Paul Fortney's work on the customer project.
Good afternoon, Paul Fortney, and I manage the product management team at OPPD. And as Emily said, I lead the customer work stream, and really our focus is how do we help individual customers reduce their own carbon footprints. Our end deliverables are going to be a product strategy as well as a 3 to 5 year roadmap of programs and products that we think we can deliver to help with their own reducing their carbon footprint. But the other big part of what we try to do is we try to create a repeatable process. At the end of this strategic initiative, when we have a strategy, we have a roadmap, we don't want to just leave it there. We want it to be an ongoing, continuous process. So we really wanted to develop a methodology and a framework that post-strategic initiative, somebody within the product development and marketing department could pick up and continue to look at. So as the world around us changes, as technologies change, as our customers' needs change, that plan will continue to get refined and redone, and will stay current, and will continue to make sure that we're meeting customer needs. not only did we want to develop a framework that was repeatable, but we wanted to make sure that it was intentional about how we went about it. We wanted to make sure that not only did it meet customer demand and where our customers want help and see OPPD lending a hand with that carbon reduction, but we also wanted it to be so that we wanted it to be repeatable. We wanted it to help our customers, but it also had to fit within OPPD's own goals, right? So it may make sense for customers, but it needs to make sure that it makes sense for OPPD's long-term goals, as well as our core competencies and our capabilities. So we needed to make sure we actually were able to not only bring the product to market, service it, and perform it so that it could pick up the initiatives and the efficiencies that we wanted to do when we brought it to the marketplace. So we started with a framework that we use every day in product development and marketing, but we wanted to tweak it to look specifically at decarbonization and how it could help with those goals. We started with this discovery and concept phase, which is really looking outwardly at not only industry, but outside of the utility industry to see what technologies are out there. Where are people making gains in carbon reduction? Where is their demand? What is interesting out there, really? So it's really just kind of a broad view of what's going on. We also wanted to look at, as we decided about product concepts and things we should consider, we also wanted to think about broad themes to make sure that it wasn't all in one bucket, that it wasn't all energy efficiency or demand side management. We wanted to look more broadly at things like education, electrification, customer-owned generation, distributed energy resources. So we wanted it to be broad. And then lastly, we also wanted to make sure that we had our customers' goals, behaviors, and attitudes about carbon reduction in mind as well. So we went and we looked at all of the outreach that we've done over the last couple of years to make sure that we understood what customers are looking for and from OPPD to do and what they wanted us to provide in the marketplace. So we pulled all that information together in that phase one. And then we went to the next phase of our process, which is really doing some evaluation of product concepts. We created a laundry list of items, which we just completed our initial scoring on. We did research on over 227 different product concepts, ranging from everything from providing rebates for HVAC to providing Bitcoin based on people's own customer-owned generation. So again, it spanned the gambit of ideas. We created a scoring model that was specific to decarbonization and looking at things that help us figure out when we were looking at a list of a couple hundred ideas, how do we normalize, how do we figure out which things are priority, which things bring the biggest value, where do we think the demand is for the customers, and again, tie that back to OPPD's goals and our efficiencies and the things that we can bring to the table in terms of core competencies. So we just completed that phase. We're now moving to the next phase, which is a deeper dive. Kind of our process starts very, very broad, where all things are possible. And then as we continue to refine and look at ideas, continue to score them, continue to do research, we get more exact in terms of potential market penetration, budgets, what would it take to build it, what would it take to run it on an ongoing basis, how much carbon would it actually save us, what do we think that the customers, how do the customers use it, and where would we need to go next with it. So that's the phase we're in now. We're taking that list of 200 plus ideas and we're narrowing that down and then refining those concepts and doing additional research, which we will then use to go out to the community and vet those ideas to make sure that we have a good list as well as the priorities correct for that roadmap. And then we'll publish our strategy, we'll publish our roadmap, and then it's kind of rinse and repeat, and we'll start the whole thing over again, and it'll be that ongoing methodology. Next, Mo. So we did do some outreach. We didn't do any that was specific to this initiative, but we did go out and look at all of the outreach that we've done over the last couple of years with customers, whether it was specific to product bills like our EV rebates and what we're doing in that space, whether it was in customer-owned generation, whether it was in things like green power, where we've gone out and talked to customers. We also looked more broadly at other research we've done, like potential studies, JD Power results, and other outreach that we've done. And we really, again, tried to understand what customers are looking for from OPPD and what are their motivations in terms of reducing their carbon footprint. And what we found out was a little bit different between audiences. For the residential customers, they certainly want to take action. They certainly want to be part of reducing their carbon footprint. And they don't necessarily see OPP as the main driver of that. They think that it's something that they need to take on. They don't necessarily know exactly what to do and where to start or who to believe. So there's certainly opportunities for OPPD to not only create products, but serve kind of as maybe a source of truth and do some education and some outreach to them to help them figure out what might be a best solution for them or solutions that they can undertake themselves to help reduce their carbon footprint. When we talk about our commercial industrial customers, they kind of saw helping reduce carbon footprint as table stakes. It's something that all of their customers are expecting from them, and as a corporate citizen, they need to do. They see OPPD maybe playing a bigger role in that than the residential customers. And when they looked at some of our products and programs that already exist, they thought that they were complicated, that they were big. And so we have some work to do there to figure out how can we help them and how can we simplify it so that they're able to take some action and make it part of their daily business. Finally, where we are today on the project timeline. I talked about kind of that process where we started big and then got more focused as we went along. We started with that discovery phase, like I said, where we looked outwardly, trying to figure out what technologies, what are things that are happening in the world, and not just in utilities, but out there in terms of technologies and where people are going and how can OPPD take action. We then started concepting and trying to figure out what products could we possibly bring to the marketplace and which of those would our customers desire, as well as which ones could we actually bring to the marketplace based on our core competencies and our technologies that we have in place today. And then we started doing the analysis on those concepts. And that's where we are today as we're moving forward to refine those concepts and finally get down to a point where we have that strategy as well as that final recommendation of our short-term roadmap. We're also working on adding carbon savings to our existing products to make sure that not only are we looking at things that we can do in the future, but the things that we have in place today. What are the results they're yielding and how can we improve those as well? So that is kind of where we are today with customer. And now we talked about community as well as how we can help individuals reducing their carbon footprint. Now we're going to talk about OPPD and how we can look inwardly at our own carbon.
Hi, my name is Jessica de la Torre, and I worked on the internal operations project. The goal of the project was to complete a corporate inventory of greenhouse gas emissions by the end of 2020. And with this, OPPD will be able to form the basis to monitor their progress towards their net zero carbon goal. First, I'm going to go through some of the work and considerations going into this exercise, and then we're going to go through some of the results and the next steps. OPPD used the Greenhouse Gas Protocol corporate standard, which gives us the foundation to prepare greenhouse gas inventory. A few things to note about that is that this is designed to be program and policy neutral. It measures 7 gases, and if you look at the graph there, they are on the top, shown on the top, and there are 3 different categories or scopes in a greenhouse gas inventory. So scope 1 is direct emissions. So if you own or control the equipment that produces the emissions, that will fall under scope 1. Scope 2 is indirect emissions from purchased electricity, steam, heating, and cooling for own use. And scope 3 is all other indirect emissions. One thing to mention is that scope 3 is optional to quantify, and there are 15 categories under scope 3. At the beginning of 2020, OPPD conducted some benchmarking to see what other utilities were doing. We sent a survey to members of the large public power council. We received 19 responses, and 7 of those utilities are doing more than just reporting emissions from their generation. Also, we looked at 2019 CDP climate change reports, and we reviewed 14 reports from electric utilities. And this exercise was very useful because we were able to see what other utilities were measuring, but also from the surveys, we were able to learn some of the challenges that probably other utilities had while conducting their inventory. So we started looking at data and started quantifying emissions. And we realized that we needed some help with the emission sources. So we went out with an RFP, and we ended up engaging Ruby Canyon Environmental, which is a consulting company that focuses on air emissions. They do verifications of greenhouse gas inventories, and they also do verifications and validations of offset projects. So Ruby Canyon Environmental led the quantification of those 3 emission sources, and we also asked them to review the methodology that we were using to quantify the other emission sources. I just want to point out that it was not a verification, it was just a review of the methodology that we used. And then for a company to do greenhouse gas inventory, they have to set organizational boundaries and operational boundaries. So for organizational boundaries, we are using the equity share approach. We had some internal discussions with Ruby Canyon Environmental. And for clarity purposes, we decided to go with this approach to avoid any ambiguity in the future with any future products or services that OPPD may provide. And in terms of operational boundary, it's basically identifying emission sources and deciding what you're going to include in your inventory. So we can go to the next slide, please. So here we can see what things we consider for this exercise. For scope 1, which is direct emissions, under stationary combustion, we have fossil generation and internal combustion engines. Under mobile combustion, we have OPPD's vehicle fleet, so our cars, our trucks, equipment propane, coal handling equipment. For process and fugitive emission sources, there's refrigerant, coal piles, transmission and distribution, SF6 leaks, natural gas pipelines, and welding acetylene, and fire suppression systems. For scope 2, which are indirect emissions, we have OPPD's purchase and consumed electricity for own use and transmission and distribution losses. And for scope 3, which are all other indirect emissions, we considered purchased goods and services, and in these we're including capital goods too. There's the energy and fuel related activities. That's made up of coal purchases, coal rail transportation, purchased power delivered to end users, and natural gas purchases. And we also considered business travel, employee commute, and waste. We're going to go over some of the results, and I just want to point out that these results are given in metric tons of carbon dioxide equivalent, and that we use a market-based method to do these calculations. If we can go to the next slide, please. So even though OPPD has calculated emissions from generation for a lot of years, for this exercise, we went back to 2017, which is the year in which we had most of the data that we needed for the emission sources that we were going to consider. The first table on the left shows the total emissions for scope 1 and scope 2. They are on average 10.33 million metric tons of carbon dioxide equivalent. If we look only at scope 1 and scope 2 only has 0.7% of the emissions, which is not a surprise because we're an electric utility and most of the emissions are from generation, which are scope 1. So scope 1 has an average 10.26 million metric tons of carbon dioxide equivalent. And if you look at the top left graph, you can see the composition of scope 1. So the big majority, 99.88%, is stationary combustion, 0.09% mobile combustion, and 0.03% process and fugitive emissions. Scope 2 has about 76,000 metric tons of carbon dioxide equivalent. And if you look at the top right graph, you can see the composition of scope 2, and 92% of those emissions come from losses in transmission and distribution system. If you look at the table on the bottom left, you can see scope 3, those are other indirect emissions. And on average, all scope 3 emissions were about 1.59 million metric tons of carbon dioxide equivalent. And if you look at the table, you can see that the energy and fuel related activities category is the one that has the highest emissions. It represents 90%, about 90% of emissions from scope 3, sorry. And then if you look at the bottom graph, you can see that category, energy and fuel related activities, and what it's made up of. 86% of it is purchase power delivered to end users, and the rest is made up of coal purchases, natural gas purchases, and the transportation of coal. If we can go to the next slide, we can see on the left, the table on the left just shows the overall results from the inventory that was conducted. And then one thing to mention is that when a company sets emission reduction targets, it has to specify what it's going to include. So some utilities, they say we have a net zero carbon goal, and it's going to include our generation. It's going to consider our generation. There's some utilities that might include scope 1, which is a little bit more than just generation. There's some that may include scope 1 and scope 2. OPPD senior management team evaluated this, and they've established that OPPD's net zero carbon goal is going to include scope 1 and scope 2. And a few things on scope 3 is that scope 3 is optional to quantify. Our recommendation is for OPPD to continue measuring the energy and fuel related services category of scope 3. It makes up 90% of the emissions of scope 3. And these indirect emissions are directly associated with the type of industry that we are, which is an electric utility that's purchase power delivered to end users, coal, natural gas purchases, and the transportation of coal. And for the other emission sources, our recommendation is for OPPD to evaluate if they're going to continue measuring them. And where do we see that this greenhouse gas inventory to link long term? We see it as part of OPPD sustainability program, which is something that Emily Muth is currently working on. Once it's established, OPPD will evaluate if it will report to an outside program. And conducting the yearly greenhouse gas inventory has now transitioned to the environmental team as planned. And the plan is for the environmental team to conduct the inventory in Q2 after they finish regulatory reporting. And the plan for 2021 is once they complete the 2020 inventory, they will be conducting a verification of the inventory. And with that, I'm going to pass it on to Emily so she can tell you about the sustainability work that she's been doing.
Thanks, Jessica. Appreciate that. Hello again. So in my day job, I'm the sustainability coordinator for OPPD. So last year, OPPD took another look at sustainability and realized that it means different things to many different people. When I say sustainability, a lot of people will initially go to the environmental piece or the decarbonization program, but or they'll go to the traditional ESG of sustainability, so the economic, social, and environmental performance, and kind of this trade-off mentality. But the goal here is to think bigger when we think of sustainability. And really, how do we tell the story of the practices that are happening at OPPD and how they're interwoven like a DNA strand into the fabric of our business that really helps spur the economic, social, and environmental performance on a whole? I'm going to move to the next slide, please, Mo. So to do that, again, we're establishing frameworks, right? We first set out to look at industry benchmarking. And number one in our industry that we look at a lot of the time is going to be the Electric Power Research Institute. They are focused on doing research in our very industry, and they've done materiality studies when it comes to sustainability and what's important, not only to us as an electric utility, but to our customers. And then we wanted to think bigger. So what is being reported from the Global Reporting Initiative? Who in other industries, what metrics are they using to monitor and measure performance? And then looking even bigger into the UN Sustainable Development Goals. From there, we wanted to align and connect all of this data from industry benchmarking to the OPPD strategic initiatives. And so looking at the strategic directives and initiatives that are happening at OPPD, the work that's going on here, we can align and form kind of this crosswalk or framework to evaluate. And we went out and did sustainability interviews. So thank you to the over 40 subject matter experts that participated in multi-hour interviews as we discussed what's happening today, what metrics are we using to monitor our strategic directives, what activities are happening, and how do these align upward through all of these parameters. And that helped us form this draft sustainability framework and potential recommendations for continuous improvement. If you want to move to the next slide. So our draft framework has many facets underneath it, but the bulk of the product looks like a three-tiered approach. So considering those ESG performance indicators for OPPD, we're looking at environmental stewardship. What are we doing in this realm? How are we serving our thriving communities through the work that we do here in this strategic initiative and others that are happening? And how are we supporting our workforce? How are we keeping them engaged and empowered? So there is much more to come. We are working with continuous improvement for implementation. The draft framework has been put together, and we intend to come back and have more discussions along this. So we've talked about community focus. We've talked about our customer product plans. We've described our internal enterprise operations with our internal ops work that Jessica has done. And now we're going to turn our focus to the core business and how we make electricity with our energy portfolio. And Colton.
Absolutely. So my name is Colton Kennedy. I manage corporate planning, and I'm also managing the Pathways to Decarbonization Energy Portfolio project, which I'll be providing an update on today. So the Energy Portfolio project focuses on developing the technical pathways for achieving net zero across OPPD's energy portfolio by 2050. And this work uses the work from the Internal Operations Project as a benchmark, but it also enables the work that we're doing in the community and customer projects by creating that low carbon or net zero carbon energy source to support the broader community. And so the topics that we'll be discussing today, in the last update that I provided, I had mentioned that we had brought on board E3. Today, there's an opportunity for E3, it's energy and environmental economics, to introduce themselves, as well as their backgrounds and their role in supporting our project here. Our work with them is well underway, and we're glad to have them. So there will be an opportunity to hear their backgrounds, and also if there's any questions that are that you'd like to ask, we can do those at the end of the presentation. I'll also be providing a high-level overview of our project modeling work plan, our stakeholder plan, integration with OPPD's integrated resource plan, as well as some of the framework we have built around multi-sectoral modeling and the definition of net zero that we're going to use for modeling purposes in this project. Well, can we move to the next slide? Thank you. With that, I'm going to turn it over to our friends at E3 to introduce themselves, and again, their experiences in related work, and then we'll move into some of the project definition and work plan.
Great, thanks, Colton. My name is Arnie Olson. I'm senior partner at E3. I've got almost 30 years of industry experience, the last almost 20 of which have been at E3, and the last 10 or 15 of which have been working really in projects helping utilities and states and other folks think about deep decarbonization, high renewable penetration, and other similar topics. So I'm going to maybe ask my team to introduce themselves, and then maybe I'll give a little bit more background about E3's work. So maybe Zach can go next.
Yep, thanks, Arnie. Hello, everyone, and nice to meet the OPPD board. My name is Zach Ming. I'm a director in E3's resource planning group and have been working for close to a decade on these topics of deep decarbonization and planning across the country. So I'm excited to bring some of the lessons we've learned in other jurisdictions to Nebraska.
Hi, my name is Aaron Burdick. I'm a managing consultant with E3. I'm the project manager for this project, and been at E3 for 2 years. Before that, I was at one of the investor-owned utilities in California, and I've been working on long-term planning, renewable integration, and clean energy programs for about 12 plus years.
So, and I'll just note, Zach and Aaron are far too modest to toot their own horns, but they really are some of our best analysts who really are getting, I think, the A team from E3. Zach's been really heavily involved in some of the really tricky challenges related to resource adequacy, ensuring resource adequacy under high levels of renewable penetration, how to credit wind and solar generation towards resource adequacy needs, both in California, the Pacific Northwest, and most recently with PJM and a formal advisory role to PJM as they roll out ELCC into their capacity markets. And Aaron has been sort of the guiding hand at the tiller with regard to the California IRP process, which is run by the commission actually in California, but it's highly political, highly charged, 5 commissioners, each with their own point of view, and a governor with his point of view, and 30 some senators, all that have their own views in the solar industry, and everybody else kind of breathing down your neck. So Aaron has been done a really nice job of keeping that process steady within the kind of hotbed of California clean energy politics. So just to give a little background about E3, we have really, I think, cut our teeth in 3 of the hardest markets, 3 of the hardest systems to do this stuff in, which are California, Hawaii, and New York. Deep experience going back, again, over a decade in all 3 of those jurisdictions, which have been really, desirous of leading the charge on clean energy, but each of which has their own both physical, electrical, and political challenges, each of which are unique and different from each other. So I think the combination of those 3 jurisdictions give us a really solid foundation to help understand how these systems work, how decarbonization can play out in practice, what types of things are achievable and what types of things are maybe farther down the road. So with regard to our practice, we kind of start with some of the stuff that we just heard about with regard to the community, with regard to the non-electrical aspects of it. We led and did one of the first pathways to deep decarbonization studies for California back in 2007-8 time period, was published in Science in 2010, was picked up by Jeffrey Sachs from that publication, and he really used that as the foundation for the United Nations Deep Decarbonization Pathways Project, in which 15 different nations did their own deep decarbonization studies leading up to the COP21 Accords in Paris. Really helped to establish more of a technical foundation for how nations might achieve deep carbon reductions rather than just making vague pledges, which is what he saw as having been the weakness of the previous COP meetings. So from there, we've gone on again to do work in New York, the Northeast, the Midwest, and both the kind of theoretical work on how this plays out, both for economy-wide, and then what the electric sector role is, and what's the role of the electric utility in meeting these deep decarbonization goals. And we're increasingly working with utilities where this is becoming reality. So it starts at the policy level, what can be achieved, and then policy gets laid out. And in places where policy is established, the utilities have to figure out how they're going to go off and implement it. How can they achieve the level of reductions that the state agencies have set out for them? How can they do that in a way that keeps their energy affordable and that keeps the lights on? Oftentimes, as I'm sure you can imagine, it's very challenging to thread the needle on affordability, reliability, and environmental goals. And so we've really have a strong focus in ensuring that all of those goals are met, helping utilities and other stakeholders understand what's realistic, what can be achieved, what the cost is of achieving those goals, and what other solutions are required to ensure reliability. And that's been a difficult challenge over the last several years, but one that we've embraced. And these types of engagements, and we're really excited to be working with OPPD. I mean, this is where the rubber hits the road. This is where real decisions get made about the future of energy facilities that you have relied upon for decades. What are the next resources that will enter your portfolio? What are the impacts going to be on your ratepayers? And so we're really excited to work with Colton and the team to help explore these challenges and to provide the benefit of our experience and our modeling tools and our framework.
Thank you, Arnie. Thank you, E3 team, Zach and Aaron, for introducing yourselves. It's certainly an honor to work with you, and you're welcome to the team as we develop this scope. So it's been incredible, and we look forward to the work as we go forward. Mo, would you mind going to the next slide? So what I wanted to share with this update is our overall project plan with the technical work. And this is something that we've developed jointly with E3, really to enable us to develop a broad set of pathways while still focusing on the fundamental objectives of affordable, reliable, and environmentally sensitive. And so we'll be developing a range of pathways that have different speeds of implementation, from conservative to aggressive in terms of the level of decarbonization or the speed that's achieved. A range of technologies from currently mature technologies, also to emerging technologies that are not commercially available today, and also a range of electric demand, from business as usual to scenarios that have complete electrification of other sectors of the economy. And so I'd start, the project starts really with stakeholder engagement, and we started with discovery sessions, and we'll talk more about stakeholder engagement in following slides. But for the technical analysis, really our work started with the multi-sectoral modeling. And this is an analysis that's currently underway, where what we're doing is we're quantifying essentially the amount of electric demand that would occur or be added to OPPD's load if other sectors of the OPPD service territory energy demands were electrified to achieve net zero. And so that may include heating or transportation, but that really supports the broader conversation around community decarbonization, and also gives us a good framework of the level of load scenarios that we're looking for in this study. The next stage of the analysis is really around reliability and resiliency. And in this analysis, we're looking to really leverage detailed loss of load hour studies or resource adequacy studies, incorporating a dynamic range of weather conditions, including, to the extent appropriate, some of the extreme weather conditions that we've recently seen or that really challenge the system. And so that's really making sure that the portfolios that we're going to develop physically have the ability to generate electricity at all times that the customers need electricity. The next step, portfolio optimization, is our work to economically optimize resources to be able to achieve those varying levels of decarbonization, or I'm sorry, like various timelines of decarbonization. So if the goal is net zero, there's ways that can be done faster or more conservatively. And so under those different conditions, what's the most economically advantageous set of resources to achieve that objective while maintaining the reliability and resiliency. Along with that will be a detailed operability and transmission analysis to ensure that there's not only sufficient resources, but those resources can perform in a way that allow them to effectively balance a system or operate on the system, considering some of the uncertainty and variability of variable energy resources. The risk analysis will shock those portfolios under a range of different market conditions or fuel prices, really to be able to test the financial robustness of them, to make sure that the direction that we're headed is going to lead OPPD to sort of a financially stable position and accepting appropriate risks. And lastly, and this is at the end of the year, we'll be developing kind of our findings and our report, and that'll include a range of pathways, so multiple pathways to achieve net zero under different assumptions. Next slide, please. And so briefly provide an overview of some of the technical tools. So with E3 on board, they bring a set of very sophisticated tools to be able to ensure resource adequacy and optimize the portfolio. And so we'll be leveraging those tools along with OPPD's tools for production cost simulation and for transmission analysis to ensure that we have a really robust analysis. But I do want to make a note here that's very important for everyone to understand, is that this is a broad study. It's a high-level study. We're testing many scenarios and different technologies. And what it's not is it's not a siting-specific scenario. It's not going to tell us where we should add specific resources. And it's not going to include detailed transmission analysis that would be required by NERC prior to actually making decisions and modifications on the system. So, before any action is taken, there will have to be a subsequent study to be able to check those boxes and ensure those constraints. And that is not part of the scope for awareness. Next slide, please.
Hey, Colton. This is Tim. One of the questions in the chat is the definition between resource adequacy and resiliency, and I think both you and the folks from E3 kind of use those, whether they're interchangeable or not. If you could just do a little deeper dive on that, that'd be great.
Absolutely, absolutely. So resource adequacy is the concept of having sufficient resources at a particular time to meet your load. And so I think when we start talking about resiliency, it's what sort of events are you planning for that could impact the availability of your resources to meet your load. And so, you can have blue sky simulations as an example, where you have adequate resources to meet your load all year round. But how challenged are those resources? How dynamic are the weather conditions that they're exposed to? What is the potential for correlated outages of facilities? There's also a qualitative component to resiliency that's beyond something that's directly modeled with what we're doing in sort of a loss of load calculation. And so I guess I would articulate it as sort of different layers, but all with the same theme. Arnie, would you have any additional comments to that?
Yeah, I might just add, resource adequacy planning is what utilities have done for decades. They've used the loss of load probability type of models that Colton mentioned, which our recap model is one of them. The way those models work is, in effect, you simulate weather and electric load and the availability of wind and solar over dozens of years, and you do that thousands of times to try to add up the number of times in which all of your resources aren't sufficient to serve what your loads might be. And you have resource outages that are random that happen as well. So, the turbine breaks down and it can't perform when you need it the most. Those things happen with a certain probability. So it's a big data probability Monte Carlo simulation where you kind of figure out how many times over the course of a given 10 years might you expect that to happen. And the standard that the industry typically uses is, once in 10 years, you're allowed to not have quite enough load or not quite enough resources to serve your load. So that's resource adequacy. Utilities have been doing that for years. Wind and solar add some complications to it, and batteries add some complications to it because you have to maintain the state of charge and you have to worry about correlations between wind and solar output and load. Resilience is something it's a little bit newer in terms of a science, And I think there's not really a standard definition for what that means in the industry. So in part, people are concerned about what about weather events that are so big, like we just saw, in Texas and in the central Southwest, that, maybe that 1 day in 10-year standard isn't good enough because that 1 day is so bad that you have the potential for loss of life or very significant economic dislocation as a result of that. So maybe resilience means that you have to understand how your system is going to perform even on that worst day as sort of an additional layer of planning that you do. Or some of the ideas about resilience have come about on the East Coast where, a hurricane comes along and it blows down part of the grid. And so you might have plenty of resource, but you can't get it to where all the loads are because some of the transmission lines have blown down. And so maybe there's a locational component to it as well that you want to think about, having a system that can island or where you can meet some of your loads, even if you can't meet all of them. That certainly the critical loads can be met to provide partial service. So there's not necessarily a clear definition, but that's one of the things that we'll be working on with the team, is how we'll define it with OPPD and for the OPPD service area in a way that makes it meaningful and actionable.
Great, thank you very much. Appreciate that.
Okay, moving on to our stakeholder plan. So there will be more content to share in following slides, but one of the things that we did is we held discovery sessions with stakeholders that have been engaged in OPPD's previous planning efforts. And the message that we received from them was pretty clear. We had a number of comments, but there was a desire for a better understanding of the topics that we're discussing. There was a desire for more transparency. There was a desire for results of more ambitious scenarios. And, folks, the impression that we had, want to contribute to the process. They want to be able to have input into the types of things that we're studying, and they want to be involved early. And so those are all things that we heard and listened to as we worked with E3 to develop a stakeholder plan, also leveraging their experience in these activities. And so we've developed a series of 6 workshops. These would be deep technical workshops that we're planning to have internally and externally. So externally with interested stakeholders, internally to make sure that the organization as a whole and folks affected by this understand the process that we're going through, and really to be able to support transparency. The first workshop, the Decarbonization Pathways Planning 101, is currently scheduled for April 7th. And so we have some follow-on dates for the next one, the next activities that we'll share later as well. But really we have 4 engagements here to really align on assumptions, talk about the modeling process before we even get into the heart of the technical modeling. And then we'll plan on sharing some of the initial results and some of the final results in those workshops. For those that can't be involved at that deep technical level, we're also engaging community through OPPD's Community Connect online portal and the Wire as well. Next slide, please. I did want to share some of the alignment between the IRP, or the Integrated Resource Plan, and this decarbonization project. So those are both major resource planning activities that will occur in 2021. The energy portfolio work for decarbonization, we've set a deadline as December of 2021, and that deadline was set by senior management and the board of directors. The IRP is due every 5 years. It's a requirement in 10 CFR 905, the Code of Federal Regulations, and it's due for us on February 28th of 2022. So 2 months after our planned completion of the energy portfolio work. OPPD may file up to a 6-month extension on that IRP submittal. And so that's important as we talk about the potential timeline for these activities. The planning efforts are similar in that they're both long range. They vary in that the IRP includes specific plans for the next 5 years, at a minimum, whereas the decarbonization study is looking at a broad range of actionable pathways over a long time horizon. Next slide, please. And so it's OPPD's intent to use the results of the decarbonization study to inform our integrated resource planning filing in 2022. However, the decarbonization study for us is a very significant effort. It includes a significant level of stakeholder engagement, of detailed technical modeling. There's the potential for unforeseen modeling complexities as we look towards these highly decarbonized future energy portfolios. And there is a risk with any of these modeling activities that it may extend past the initial deadline and perhaps past the initial IRP submission deadline. And so it's our intent that the energy portfolio work really supersedes the IRP, and the IRP is just a technical filing that needs to be done for the five-year plan. And if the decarbonization work were to extend past that deadline, that OPPD would always has the option of updating its submitted IRP with a new plan. And so our focus here is on the decarbonization work.
Yeah, Colton, let me just real quick for the board. I think this is really an interesting, and there may or may not be a misunderstanding about this that we can pull off later and have a discussion, or in my one-on-ones coming up over the next several weeks, is that the IRP work that we have to file because of our agreement with WAPA is not a decision point in any decision portfolio or anything that we do at that point in time. It is just a regulatory filing. And we're trying to use the best information that we're developing through this decarbonization initiative to be able to do that. So I just want to separate the decisions that come after from the actual filing of the IRP. And I think sometimes I hear some words that may have some misunderstanding about that. So just to have some clarity around that, I think is going to be pretty important. And I appreciate the team trying to put together this project so we have the best information through this decarbonization effort that we can use as part of our IRP filing with WAPA. So thank you.
Very good. Next slide, please. Okay, so here's where we'll begin to share some of the some of the initial technical work that the team is conducting. So one of our first activities on that project work plan is the multi-sectoral modeling. And so just to provide a little bit, the next layer of detail on this is a study that we're doing that's really looking around at economy-wide decarbonization for OPPD's service territory to understand what other uses of energy are in our service territory, and if the territory as a whole were to achieve net zero, what would happen to OPPD's electric load profile? And so there are different ways that could happen through electrification or for use of biofuels. And so this study is really around the range of what that future electric load might look like for OPPD, really to inform us of what sort of loads that we might be needing to plan for. As we do this study, it really also supports some of our community conversations and just our leadership in the community around not just energy demands that are electric today. Next slide, please. And so one of the first, I guess, technical considerations that the team came across is really this idea of defining what net zero is. And so the graphic that I have here is really a spectrum of things that are that all might be categorized as net zero or sort of different utility goals. And that spectrum ranges from most constrained states to least constrained states. And so if you look from left, on the very left, we have something that's 100% renewables. And so this would be a planning objective where you're looking at resources such as wind and solar and storage, but you're not allowing things like nuclear or combustion of clean fuels. It's 100% renewable. And so that is something that is perhaps outside of what OPPD set as a goal for itself, but is considered, it can be very expensive as you seek to firm up some of those loss of load hours at very high levels of decarbonization. So moving to the right into zero carbon, this can also be called absolute zero. And this is an objective where 100% of the generation is zero emitting. And you might achieve that through fuels such as green hydrogen or renewable natural gas or nuclear or carbon capture and sequestration. Really, the fleet in this case isn't allowed to emit any generation whatsoever. And so this can actually be higher cost than the option that's to the right of this, which is net zero carbon, which includes, it still allows the opportunity for some fossil generation if it economically makes sense, but it has to be offset with non-source tied carbon capture or sequestration, or just carbon capture offsets. And so we'll discuss what some of those offsets might look like. And there's certainly a lot of discussion around what are appropriate offsets, or what offsets can be used by a utility to achieve that net zero. And moving to the farthest right is near zero, where the portfolio wouldn't actually achieve net zero, but would be close. As an example, you might have 1 to 5% outstanding emissions that aren't solved for the portfolio. And so this could be cheaper. It's not OPPD's goal to be near zero. It's our goal to be net zero. But studying a scenario or an objective like that helps us understand what the marginal or the incremental cost is to move from that near zero portfolio to net zero. Next slide, please. And so when we're talking net zero, there's also, you're netting it against something. And so you're netting it against offsets. And what offsets are you modeling? We've categorized these into kind of 4 different areas. Offsets that are related to electricity exports. So this is if you're selling green energy off your system, does the reduction in emissions by another party count as something that you can offset your own portfolio with? In the upper left, it includes, there's also intersectoral credits for offsets, and this would be the idea of if the utility is encouraging vehicle electrification, can it count the reduction in emissions by vehicles as part of its reduction for its own energy portfolio? There's greenhouse gas offsets in the lower left, more traditional activities such as tree planting or direct methane capture off of farms or landfills. It's low cost, and there's certainly folks that offer this today, but it can be difficult to prove additionality of some of those GHG offsets. And the lower right, probably the most clear in terms of being able to count, would be negative emissions technologies. This would be items such as like direct air capture, where you're actually capturing carbon dioxide directly from the air. These technologies are certainly uncertain in terms of their cost and are very early in their maturity. Next slide, please. And so as we consider modeling net zero, we have to put math to how we're achieving it. The way we're looking at this from an energy portfolio perspective is that we would account for scope 1, scope 2, and scope 3 emissions within our energy portfolio modeling. And there's a reason for scope 3 emissions, and I'll get to that. We would exclude OPPD's emissions that are not part of the energy portfolio. And so what we're saying is not that it's not important to achieve emissions reductions in those other categories, but that would be effort through our other programs, like our sustainability program. When we look at our vehicle emissions or fugitive emissions, or if we look at our business travel, those are all types of emissions that we would not solve with our energy portfolio, but we'd have other opportunities to solve for within our broader decarbonization program. And so we'd be focusing on, again, the scope 1, scope 2, and scope 3 purchase power emissions. The reason for inclusion of purchase power here is that from a modeling perspective, it's, if you're purchasing, we wouldn't want the model to retire all of our assets just to go buy it off the market someplace else. Really what we're trying to achieve from a modeling perspective is, low emissions or net zero emissions for the load that we're serving, and for OPPD's energy portfolio directly. So that's the reason for inclusion of purchase power within this technical modeling scope. And on the offsets, our goal is to help inform how we might define this goal and how the organization might go forward in terms of identifying offsets that could be used to achieving net zero. And so what we're proposing for this analysis, or really the way we're proceeding, is to include a sensitivity analysis for GHG offsets, for negative emissions technologies, and for electricity exports. And so we would study incremental levels of, or options where we can achieve net zero with those categories of items, either allowed or not allowed. And on that excluded item for the intersectoral, it doesn't mean that OPPD wouldn't advocate for reductions across other sectors in the community, but we wouldn't use it to count against our portfolio emissions today in today's modeling effort. Next slide, please. And so from a modeling perspective, we do think it's valuable to model these different objectives and the different sensitivities around the offsets. And so we would still propose modeling the absolute zero scenario, the net zero, and a near zero. Just as we, as we heard in some of the stakeholder outreach, stakeholders sometimes want to see extreme examples, and so we think that absolute zero is one, maybe not extreme, but one, harder to achieve scenario. And so what's the incremental cost of that type of scenario, and what's the incremental cost of net zero versus near zero? This is all information that we look to create or derive from this analysis to be able to inform future decisions. Next slide, please. And lastly, where we are with the energy portfolio. At this point, we're refining and beginning to implement that internal and external stakeholder plan. We're actually in the process of the multi-sectoral modeling now. We're in the process of gathering all the data from a financial and production perspective that we need for our technical modeling. Also interviewing individuals for an external oversight committee, industry experts, and so that's in progress. Upcoming, we have our first stakeholder workshop, which is scheduled for April 7th. We're in the process of developing methodologies for screening and evaluating some of the technologies. We have a technology exploration sub-team that's identified over 150 types of different technologies. And so how do we bring that to a more manageable list to be able to include our modeling? And lastly, we're upcoming is the characterization of risks that would be included in our portfolio resiliency and reliability analysis. And that's the content that I have for the energy portfolio. So next slide, Mo.
maybe before you move off of this topic, if there's just a couple of thoughts I might have to help give the board some perspective on the modeling work that we'll be looking at. You know, whenever any one utility sets a goal for themselves in context of today, right? So in effect, and there are a number of utilities that have done this. We want to achieve 100% clean energy by X date, 2040, 2045, 2050. It's important to first take a step back and think about the context in which those goals are being set, right? We're doing this because people understand that there's a carbon challenge, that there's a climate change challenge that's happening. The climate's changing around us, we can see it. We know that the science is telling us that it will continue to change if we continue to emit carbon into the atmosphere over the next 10, 20, 30 years. But what we don't have is the ability, given our current political situation, to achieve kind of a nationwide consensus on what the right response is to that. You know, we can't go to Washington and say, Congress, just get together and ignore your partisan differences and let's develop a scientifically sound plan. We're just not in a place where we can do that today. There's too much disagreement. So, but it's also the case. So if people are acting on their own, OPPD, many other utilities are taking matters into their own hands, saying we want to cut through some of that political uncertainty and establish a future for ourselves, chart a future that is more certain, that where we can feel good about the actions that we're taking and the impact that it's having on the environment. It's also the case that the actions, the ability of any one entity to affect the climate is limited. And so it's important to understand what the role is. Every corporation needs to understand what its role is. Every utility needs to understand what its role is, what its proper roles are, and pushing change along and making change within its own organization. And so a lot of the themes that we'll be talking about with the team are, what are the interactions that OPPD has with the world around it? And this gets into a little bit some of the questions about electrification that Colton brought up. You know, what is or should OPPD's role be in providing the gasoline of the future? You know, developing charging stations so that people can charge up with OPPD electricity rather than buying gasoline from Chevron. What should OPPD's role be in potentially pushing heat pump technologies into homes so that they can heat their homes with electricity from OPPD rather than natural gas from from a gas company? Similarly, what should OPPD's role be, and how does OPPD interact with others around it within the Eastern Interconnection and within the Southwest Power Pool market? Those interactions are going to be very important. It's easy to think of a portfolio of resources as being dispatched on behalf of OPPD loads and kind of ignore the world around it. But in fact, that's not really what happens. OPPD's resources are dispatched into the SPP market. Much of that power probably flows to OPPD loads, but some of it flows to other loads within the interconnection around you. And similarly, OPPD is every hour and in fact every 5 minutes buying and selling, you know, buying energy from the SPP market and selling energy into the SPP market. Similarly, SPP has a role in helping to ensure resource adequacy within the OPPD system. There's benefits from being part of a larger pool to where if OPPD has resource outages, resources can ramp up in a neighboring system to serve OPPD's load, and similarly, OPPD can help backstop some of the resources in the other parts of the SPP market. So a lot of these kind of interactions, what is the appropriate role of OPPD within this broader political context is, I think, will be a big theme and a big place where, you know, some direction and policy and thoughts and dialogue with the board will be useful.
Thank you, Arnie. We have one more section of content, and I know we want to leave some room for questions here. So with that, I'll turn over to Tim O'Brien to discuss some of our outreach opportunities.
Wonderful. Thanks, Colton. It's a real pleasure to talk with everyone again today. Arnie, I appreciate your comments on the political front. That's near and dear to my heart, so that'll certainly carry through the discussion. Just to forecast, I have 3 slides here. It'll take us about 5 minutes, and then I'll hand over to Mary Fisher for the Q&A time. Want to give just a little bit of a roadmap building on from what Colton and others have stated from a stakeholder engagement perspective. We have definitely taken to heart the feedback from the board and the public on our stakeholder engagement efforts. And so I want to walk through some of the things that we're doing, improving on, learning about, and driving forward. So one of the first things that we wanted to do is just listen. And so from December through January, many folks on the call that had presented earlier, we went out and just talked with many of our stakeholders and had a quick update on what decarbonization is, but really listen to them. So we asked open-ended questions. You know, what interests you? What's important to you? How do you want to be engaged? Who's doing this well? How can we provide feedback? And really a collaborative discussion, and we learned a lot of things. And I'll show those to you in the next slide, Mo, if you would go to the next one. A big one is just stay ahead of where we're going. And we took that to heart very clearly from Colton showing the slide of where the workshops are going. So we're trying to lay out our whole year. Here's what some of the slice of engagement will look like. Certainly we'll reach out in other ways, which is the next slide. Many folks just said a layered approach. There's very technical folks, there's membership-driven organizations in this topic, and so continue to do more recorded sessions, surveys, materials, videos, tell the story, continue to put updates in outlets for every customer to have. And then a big one we heard is just general education. Our business is so complicated and so many attributes. Just continue to be available to educate, to do lunch and learns. And so we intend to do a lot of those throughout our process. TAC 3 on here talks a little bit about how we use the feedback. And so we call, or maybe it's TAC 4, excuse me, but just the loop back. If we've received feedback, what does that look like? How did we implement it? A great example is what Colton and Arnie talked about earlier, is the different stage gates of here's the universe of potential technologies and opportunities with the decarbonization portfolio. Here's how they fit. Here's how they may move into next phases in the screening process. And so we're going to be very deliberate, what I'll call on the loop back for feedback of customers. And so we're very focused on that. Let's see, what was another good one? Also be very clear. Here's what the expectation is. So moving into every event that we have, what's our objective? What's our potential outcome? And is there an IEP2 level that's appropriate? So we're going to be very front and center on those topics. Some folks wanted to use technology more. And so we've been working to use Nextdoor, text messaging. We've gotten pretty good success. And even in these discovery sessions, we've got to educate our stakeholders on OPPD Community Connect. And we've got some very active stakeholders now using that tool. It's just been a wonderful opportunity to do that. We've also heard that more rural representation. So we had some conversations with the Center for Rural Affairs, for example, to talk about how we engage them or youth in other areas. Another piece is just stay ahead. So I call this getting on people's calendars for lunch and learn. So the folks that have interest in our business, we're just going to go out and let them know when we would have time to update them on our process. And that's starting very much right now with this update that you're hearing today. And then the portfolio option of our first workshop will be what is decarbonization, the 101 principles. And so we'll use that. That'll be a good venue for continued, what I'll call lunch and learns. It also is a lot of the work that the public affairs team does on a daily basis, working out with our stakeholders, similarly with our account executives and others, just staying in touch from that perspective. One thing that was an aha to me is that many folks said we were doing a lot of things right. We asked a question about who's doing it well, who can we benchmark against? And I was surprised we didn't get many responses, frankly. I was expecting, go look at this, see this group or entity. And so we took that to heart. So what are we doing based on that? We're doing a lot of benchmarking right now. So we've done a customer outreach survey on how customers want to engage. We're doing desktop work from other utilities and how they're doing their IRPs and decarb work. We're also doing interviews. I think we've done 6 to date on various entities, public power or not, to understand what they're doing. And we're committed to share some of those findings with those other utilities that are interested in hearing it. And then we'll share with the PI committee and board when appropriate as well. So we're out doing those things to better understand how we can best engage. So I'm really excited about that process as we're continuing to strive for continuous improvement. This was something that Lisa Olson did a number of years ago, creating the original stakeholder process, and so we're building upon that. And we took many of those attributes into our plans, and we're going to continue to check and adjust as we're moving forward. And so we have a runway over the next couple months, and we're going to continue building the robustness for stakeholders to engage. And I really appreciate our friends from E3 helping us in that expertise, doing this around the country. So with that, a few of the lessons learned. Mo, if you'd go to the next slide, this is what we're really excited about and to announce, as Colton described, is our first workshop. It's the 101 of the decarbonization pathways. So it's going to be 4 to 6 is the time. We will send invites and details that'll go on our OPPD Community Connect website. We're also sending out to our different stakeholder lists, elected officials, social media. We've got a whole campaign around helping folks understand when this event will be. We will also have, we're planning another event, the second phase, on the 28th of April as well. And so we're going to ask our stakeholders what the best time would be, if it's a late afternoon, evening, or some have requested even over lunch. So we're working through that. All these will be recorded. And in advance of all of the workshops, we will have an employee workshop to go through and get perspectives of our employees. That'll also continue to prepare us for the public workshops where folks can engage. Our intent is to move through about 4 of the workshops around the Memorial Weekend holiday, and that'll help us start the modeling process, help folks understand the screening, the process, the weighting, et cetera. And then we'll go to work a lot through the summer, and we'll also continue to educate on other aspects of decarbonization. And then following up, there'll be another couple workshops later this year that we're working on scheduling. So we're quite excited about that. The other thing that I'll highlight here is that we're moving pretty far in the IAP2 spectrum that we've been doing. Rather than just informing, we're really in the involve category, which is to work directly with the public so they understand the process, what the concerns are, and understood where we're headed. And we're going to use several metrics to understand that. We do it today. We survey all of the folks that participate in our workshops and events. We intend to do that, as well as also those that are maybe perhaps looking at our website or engaging in other ways. And so we are really trying to deploy a whole bunch of tactics through this. Again, these will be recorded. All of this will be housed at OPPD Community Connect. So if somebody can't make it, they can watch it and provide feedback through that mechanism. So I'm really pleased to announce this, the 7th and then the 28th. If you put those 2 dates on your calendar, that would be excellent. And with that, that concludes my remarks. Mary, I'll turn it over to you.
Thank you, Tim. I appreciate that. As you can see, it took us almost 90 minutes to get through this. I appreciate your patience with allowing us to get through it without the interruptions for questions. And I'm sure you have a multitude of questions that the team is here ready to answer. I know we've been doing lots of chats and answering some of these as we went along for clarity. But please ask any questions that you would care to ask of the team at this point in time. I just want to reiterate what Tim O'Brien just said. April 7th is our first public meeting, and it is an education and general overview of the project process, timelines, and objectives. And so these are public meetings that we're talking about when we're discussing these workshops. I know that was a point of clarification that was being asked for. But this time, I'd just like to turn it over to the Board of Directors for any questions you may have.
All right, thank you, Mary. I think that right now I don't see any hands, but I'm sure that will change shortly. I wondered if we should probably go ahead and summarize a couple of the questions that were in the chat, because I'm not sure that the public can see those. So let's see.
Yeah, most of them were clarifications about some of the terms that we were using.
Yep, you're right. Director Yoder, would you like to start? Because you had a couple items here, and I'm wondering if there's a question that should be asked in a public way.
Well, I don't know. I think that I heard a planning down in Miami introduced me to the term of adaptation pathways. How do you plan to build today for something that is going to happen 30 years from now? And is there an iterative approach? Can you start this way and then jag off in that direction? And how will this report help us with that thinking?
Maybe I'll just start with that, and then Colton and our friends from E3 can join in. That's why we've called this a pathways to decarbonization, because we do know that there will be developing technologies. There'll be other things that will come along that we'll want to embrace as a utility for our customer owners. And so, you know, we have to keep an eye on the near term, what we need to do in the near term to meet our customers' requirements in terms of, you know, load and capability. But we also have to keep that forward-looking perspective to understand what pathway is going to get us to meeting that net zero carbon goal by 2050. And so that's why we've always called this a pathways to decarbonization, because it gives us different options as how to move forward. And to your point, Director Yoder, we do have to be adaptive and create that balance as we move forward in this process. Colton, I don't know if you have anything to add, or Jeremy.
Yeah, I would supplement a little bit, Mary, in that you know, one of the ways that we're approaching modeling is sort of with I'll take as an example as the technology. So we'll have one case where we're looking at current technologies, and we'll have another case where we're looking at emerging technologies. And this is only one of the variables that we're doing sensitivity on. But if you can create a pathway under both those cases, and you can see here's the common decisions across those multiple pathways, you're sort of getting a perspective of your no regrets decisions, things that are robust to multiple futures. And so, you know, that's sort of at the core as we look at these different pathways under different sensitivities. What are the commonalities and what are the differences? You know, I think that information helps you understand, you know, how much do I need to position myself to change, and how much, you know, can I make, you know, some investments today that are going to be longstanding to support the goal. So that's how I would answer it. If Arnie or Jeremy would like to supplement.
I mean, yeah, I may just build a little bit on what you said, Colton, about the transformative technologies. I mean, I think what we typically find is that you can get a long way with existing technologies, but probably can't get quite all the way to the 100% zero carbon goal with existing technologies. So then the question becomes, what technologies do you need to develop and become commercial in order to get all the way to the goal? On what timeline, and what role can OPPD as a public power utility play in helping to push some of those along? And how do you interact with DOE and R&D dollars and all of the other things? And what are the pathways that cause those technologies to come into the marketplace in a way that makes it possible for you to rely on them? So we'll have to, some of our work will be qualitative in that sense, charting out what some of those futures might look like. I might also add on the adaptation that I think that is already a reality, and utilities around the country are increasingly beginning to grapple with this question of what is our load going to look like in the future as the weather changes. So especially in the desert Southwest, it seems, you know, and there's a historical record now of increasing frequency and intensity of heat storms, and what's that going to do to the peak load conditions that those utilities have to meet. You know, these increasingly extreme polar vortex events seem to be also climate related. That's maybe a bit of a more chaotic phenomenon, but we have to grapple with, at least the best we can, what that might mean for variations in future electric load. And then similarly, the frequency and intensity of storms, you know, tornadoes and high winds and those types of things. And there may need to be some hardening of the facilities that come out of that. So adaptation is a reality. I don't know that that's necessarily the highest focus of our study, but it certainly is one that utilities everywhere are beginning to grapple with.
Thank you. Director Moody, you have your hand raised.
I do, yes, thank you. So first, let me, I just want to highlight how fantastic this conversation has been. This is really important work, and I think we all take it extraordinarily seriously. And I want to thank the team for all of the good work to date. Super excited to meet the E3 folks, and I'm just, tickled about the work that we're doing and where this is going, and I can't wait until the end of the year to see what the end product is. So kudos to everybody involved. I have a handful of questions. I'm not going to ask them all. A couple or I just want to affirm a couple of things that I'm perhaps assuming that I don't want to assume, and then I've got a couple of questions. We talked this morning briefly about something that we saw come out of MISO with respect to transmission challenges related to all this. I assume that taking into consideration transmission limitations needs is part of what we're looking at from a modeling standpoint.
So there was a reference early on in the energy portfolio content. I think some of those things are only observed with very highly detailed transmission modeling.
Okay.
And so that's something that's hard to do, both broad and very deep. And so our plan with this study is to make sure that we're looking at the right technologies, the breadth of technologies. And I would say that's why it's pathways. And so as we move to maybe the next step is then we would need to make sure that that type of analysis is done.
Got it.
Yeah. And the type of thing that we're doing with resource adequacy is also making sure that we're not overly dependent on external entities too. And so what is the line of independence versus dependence, and where do we want to be? That'll have to be part of the conversation.
Okay, that's helpful. Thank you, Colton. I do have an outstanding question with respect to how all of this fits together with the Powering the Future 2050 stuff, but put a pin in that. I don't want to talk about it right now. I think I can get that offline. I think the big question that maybe I want to ask is about the way I've been describing this ever since I first learned about this study was what are the different pathways to get to this net zero goal, and what are the implications of each of those pathways? That's how my simple mind has been able to communicate it to the general public. So my question then becomes, I understand the pathways concept, but I'm curious about what implications we're considering as we study that, right? It's clearly about reliability, resiliency, and the financial piece. Like those are the big ones for us, but are there other implications that we're also taking into account as we explore all of these different pathways?
So I'll just take a quick comment on that, Director Moody. Thank you for the question. All of these initiatives, right, are pointing us towards a variety of futures, but futures that all include the aspects we've talked about this afternoon. And so when we're talking about the grid mod strategic initiative, we're working towards having the crossover between those so that the implications of this work can be understood in that section. Similarly, when we're talking about the workforce transformation strategic initiative, we're working hard to have implications of this work be considered in that strategic initiative. And it's going to be an iterative process as we get results from this, as we get more clarity along the line. But it's certainly not lost in the organization that there's implications of this work that impact the other areas of our business.
Yeah, that's helpful, and a good reminder that these strategic initiatives are completely intertwined, and you hit a couple that I definitely had on my mind. Obviously, the customer-focused one as well is pretty clear. I guess the only thing that comes to mind for me in addition to that is, we use the United Nations Sustainable Development Goals early on when we were talking about informing our own sustainability definition and framework. And I think it might be interesting to think a little bit about how this spillover affects some of those sustainable development goals that we have very broadly, right? And those, for those that aren't familiar with them, are far-reaching, right? It's not just emissions; it is clean water. It is, there's a racial equity element. It is massive, and I'm not suggesting that that's what we consider, but that's clearly the direction that the globe is going when we think about what does sustainable development look like. And it would be interesting. I don't want to create a bunch of complexity in this because it's already complex enough, right? But I'm just kind of curious about the spillover effect of what we're about to undertake and how it might affect some of those writ large as well. Over.
Yeah, the only thing I'll appreciate those comments again. The only thing I'll add to that is, you kind of nailed that sustainability word. That's why as we looked at this internal operations work, and we said a lot of the stuff we'd set out to do to change processes and to change culture internally, that can't, decarbonization, we won't take our eye off of that. That's important. But we don't want to miss the opportunity to have it in this bigger sustainability conversation, that work that was underway, that Emily's working on. And so that's why we saw those two naturally coalesce into a really important effort that I think you're going to see as an increasing piece of our planning as we talk about powering the future to 2050, as we talk about all these planning efforts. It's just the conversation around that's only increasing.
Well, and I think
it brings up a good.
Go ahead.
I'm sorry, go ahead.
I was going to say, I'm wondering about the implications of if OPPD moves in this direction and we're part of the SPP, does that limit other members of the SPP to also make the same or similar move? And I think that's something that we've talked a little bit about over the last couple of years, and I don't think any of us have a clear picture on what that is. But to Arn, to your point earlier, there's not a national direction that we're all trying to, go to the same place, get on the same bus and move in that same direction. And I'm personally concerned about that. And I think that that's one of those implications that, we need to keep in mind as we're moving forward through this study. So.
Yeah, I think, this is Tim. I think one of the challenges, talking to the reliability side in the conversation I had with Jim Robb a week ago with the president CEO of NERC, very clear, the word adequacy that they're using is just that. Do they have the right adequate resources that will operate on the most significant days, low probability, high impact, across SPP, across ERCOT, across MISO and others? And how does that change going forward? At the same time, we have an administration that's talking really about climate change and other changes going on, and those two may coalesce just because of the administration impact to FERC and ultimately to NERC and how that works. But even at the end of the day, we're going to have adequate resources, regardless of what they are. So to be able to maintain those, the grid stability, to maintain energy resources. So I think this is going to be, kind of interesting going forward, short term and long term. But I certainly see it as being a doable, regardless of who you are in SPP. You got to have the right adequacy of resources. Some of those resources may only operate when other resources can't or don't operate, but you have the capability to have those resources operate to maintain grid reliability and energy, to your customer owners. So I'm under the impression, and it would say you're able to do both of those, and that anybody in SPP with that same approach around adequacy, around resiliency, around reliability can get there. It just means the portfolio is going to be completely different than it is today, and we have to have that understanding. So.
Thank you. Mary, you were going to say something before I started.
Kim covered it, so thank you.
Okay, very good. Director Williams.
Yeah, I guess kind of a general comment. First, in following on what Craig mentioned about the UN Sustainable Development Goals, I think it's important that we keep equity at the center of our strategic planning that we do for the future, both through decarbonization and our vision of what we want to be in 2050. I know we've talked about this as potentially a topic of environmental justice or energy democracy in the past, and we don't really have anything incorporated into our mission or vision or values right now, but I do hope that this will help us to have some of those discussions so that we can make sure some of the problems that we know have come up in various areas of our society that OPPD could have a positive influence on, that we can keep those in mind as we plan for that clean energy transition for the future. So I appreciate the fact that this gives us an opportunity to consider some of those kind of large systemic things that are built on the foundation of infrastructure like electricity, that we can have a positive influence on and achieve some of those other goals as well. I did have a couple questions. Are we expecting a projection of annual carbon emissions to be part of the pathways modeling or some version of the presentation here that we would see at some point throughout the year? And I guess this question ties back to the kind of SD7 specific metric. And when we approved that originally, there was the discussion about what we called, I don't know, legislative intent. What might the curve look like from 2020 to 2050? So is that the type of thing we would see from the modeling sometime this year?
Yes, that's fundamentally how the model works. There may be different modeling points and snapshot years that we're looking at, but you'll have I mean, this effort will produce the ramp down in emissions over time.
And so that will be a part of a presentation. I guess, can you give us an idea of, is that part of the pathways, or is that just a graph in the final report in December?
I would expect that you would see that with the initial workshop on the initial results, which will be at the end of the summer timeframe.
Thank you. And then secondly, we talk about resource adequacy and also resources planning for the expected potential future use case and load that we might have. Will the models project the types of new resources that we might need? You mentioned not specific locations, but the types and quantities of new resources that we might need, or the types and quantity of resources that we might have that we might no longer need in the future. Is that an expected outcome of the modeling? And if so, is that also kind of at the end of the summer, or when might we expect that type of information to be available?
Yeah, that is part of the definition of the pathway. It's sort of like the resource decisions that we take to get from point A to point B. That being said, you know, our approach is to have multiple pathways, and so that you may see different resource mixes and different combinations in those various pathways. So, you know, not a specific set, but you'll have a vista of multiple pathways.
All right, Director Williams, are you complete? Was that a thumbs up? Sorry, I may have missed it. Okay, thank you. Director Spurgeon, your turn.
This was so comprehensive. I am very pleased to see the emphasis in reaching out to the community, and because I think people are hungry for information. They are hungry to know, what can I do? What's my part? How can we help with this? The polar vortex situation, I think, revealed that people are very willing to do what they need to do to keep the grid stable. I mean, that's what I'm taking away from that, by and large. And I just think it's super that this kind of community outreach and interrelationships with the customers, and saying, you know, what do you see? What do you want? What would be helpful? I just think it's going to yield some very helpful information that is going to inform our procedure, our light the pathways, multiple pathways, and be very helpful to us. So this just sounds really comprehensive. I don't know how you're managing to get it all done, but I'm very glad you are. Thank you.
All right, thank you, Mary. Let's see, do any of the other directors have any questions? I see some head shaking. Excellent. Well, I'll also echo the thanks for all of the work. It was extremely comprehensive, and we appreciate the multiple layer approach that the team is taking in tackling this, because it's certainly not an easy challenge. And I I don't have any questions myself right now. They've been answered through the course of our discussion. So I think with that, we might be finished with our meeting today. Any other comments?
Yes, Chair Bogner, I just want to thank the board. Great, thoughtful questions in the chat and in out loud. I just really appreciate that. And to Mary's point, this team has done some really good work about laying this foundation that I think is going to be really important. And so as you think about what you heard today or what you saw today, please don't hesitate to engage back with Mary, myself, or others on the senior team to make sure that we keep this conversation going. I think that's going to be pretty important. So thank you very much.
All right, absolutely. Well, with that, we will go ahead and close this meeting. Thank you all for your time.